people have asked about CE credits. If you are applicable, if it's applicable that you can get CE credits from attending the conference, please do just email Karen directly and she will liaise with you. Also wanted to mention that the next SWFI event will hopefully be in Austin in April next year, so we'll make sure that you're aware of that. Our opening panel today is looking at, is there a new world order? And I'm very excited to be doing a one-on-one discussion with Jacques Demers. He wears two hats, so he's on both the buy side and the sell side. We can talk a bit about that. He's the chairman and managing partner of Agawa Partners, and he's also on the York University Investment Committee. So we'll be picking up on some of the themes that we discussed yesterday with Russia and China and the US and where this all fits together. So let's take it away. So I just introduced you by name and title, so perhaps you want to give the audience a bit of a background as to what angle you're approaching this from.
Good morning, everyone. This is what? Good morning. Good morning. So, I wear a number of hats, but I'm not here to talk about Agawa and what Agawa does. Happy to do that offline. I'm chair of the York University, which is Canada's third largest university, based in Toronto, Ontario. Chair of the pension fund and the investment committee. And it's a small approach, so it's not direct investing that's used. It's a small internal team, and then we select based on the asset mix, interview and select our asset managers. So I think it's kind of in that context as we can get into some interesting discussions, and then the question is, well, so how do you deal with that from an investment perspective? So that's the perspective I think I bring today.
So if we're looking at the title of this is there a new world order and how can sovereign wealth funds prepare for it? Maybe we start with what is the current world order and how did we get here?
Okay, well, I'm happy, and these are my opinions, so I'm happy to take a stab at that. I don't think we're in a stage where the next new world order is struggling to be born, basically. That's the stage we're in currently, in my opinion. And if we go back historically, just to the end of the Second World War, the primary force in that war on the Allied side that came to bear and brought that war to a close was the United States of America. In Europe, we know that Stalin-led Russia continued on into Eastern Europe, and the USSR was formed or existed at the same time, but extended its reach. And for a number of years, the Cold War, the bipolar world order, was dominated by the United States, and then in primarily a defensive mode, the USSR. I just want to also go back to Asia, that part of Asia where Japan had been vanquished, and the initial, under MacArthur, the initial plan was to, and there was a new constitution that was brought into place in Japan, but was to basically democratize in a Western way Japan. And to an extent, the Japanese accepted a lot of the changes that were encouraged / imposed. But on the other hand, because of the USSR, and then the communist revolution taking place in China, the U.S. quickly befriended the Japanese, and Prime Minister Yoshida in Japan took advantage of that. So big brother U.S. military plans, everything, all good, you take care of it, you pay for it. And the focus that the Japanese policymakers took was to rebuild their country, rebuild their economy, and compete and grow on that basis. And it worked quite successfully. I recall, I look around the room, and I'm clearly the oldest or among the oldest here. You know, in the 80s, we were reading books about Japan coming and taking over the U.S. auto industry and so on and so forth. So that didn't quite happen, but the effect of that strategy, having Japan allied with the West in that part of Asia, right across the sea from China, was strategic and part of that world order, post-Second World War world order. So you had bipolar. The Nixon administration, Henry Kissinger, China, meanwhile, was not playing in the world order economically and trade perspective until the U.S. administration at the time went to China and said, why don't you play with us? And so in the early 70s, that step of inviting China to participate started to occur in a meaningful way. And investors at the time would have been saying, geez, you know, you put your money in, but it takes a long time to get any money coming back. Though that was the way it took place, understandably. That's not necessarily the way people are talking about China today, right? So, but once that happened, in addition to any internal issues in the USSR, you started to see a move away from the bipolar nature of world stability, world trade, economies at play. And of course, as China built up, that increased. And also during that bipolar era, to this day, just a little heads up on perhaps where are we today, India, which became independent as the British Empire crumbled, and from a British perspective, the Commonwealth in their world at that time was the world order, replacing the empire. Not quite, but in their eyes. I'm not trying to be critical of anyone, by the way, who's British background, if you analyze it. India became independent, and of course, then India and Pakistan developed in that region. But India has, going way back there, basically secured almost their entire weaponry, arms for defense purposes, etc., from the USSR/Russia to this day. The French have made some headway in selling weapons to India, but that's where they've been playing for a long time in terms of supply of weapons. It may be, here's my, on a lighter note, if one can make a lighter note, it may be that as they watch what's unfolding in Ukraine, they may revisit the wisdom of continuing to secure weaponry from Russia. So bipolar, but bipolar on top, certainly for all of us here. I remember in the 60s in school, the siren being played for, you know, get ready, go to the basement of the school, so on and so forth, missile drills. And so we were in that mode, but at the same time, if you step back from it and just absorb what I'm saying, is in the broader, bigger world, it was bipolar for sure in the rebuilding episode of Western Europe and Japan. The U.S. was at the center of the free world, we used to say, and the USSR was playing defensive tactics vis-a-vis the U.S. Okay. So that brings a degree of stability with it, though, for investment decision-making, so on and so forth. That's the way it looks. There are a few uncertainties here and there. There always are in life. But it brought a degree of stability. And then tensions and emotions escalated, if we recall, and other factors, you know, terrorism going on primarily in the Middle East, Northern Africa, etc. And then the USSR, basically its time had come to, it wasn't working. And later, if we get to that, you know, a lot of changes occur from the internal integrity within in this era of the nation state, which I think is also an open question in my mind as to whether, but for the United States and the strength of the United States, we'd still be calling it the era of the nation state, sovereign states, United Nations, etc. So, won't go there. We may run out of time, and we want to get engagement from you in the audience. So that, I think, is part of the history getting us to where we are today. The wall came down, so it went from bipolar to unipolar, or single polar. But China was rising. Europe was reintegrating to a degree, the non-USSR countries in Europe. A country like Ukraine, of course, Crimea, just again factual, was administratively transferred to the USS state of Ukraine in 1964, I think, for administrative purposes. So there's history in Russia that we have to try and understand a little bit as well in terms of some of the issues that are going on in Russia and in the Ukraine, if we wish to have a better view of some of the history behind that. But it was unipolar, and I think during that era, going back to the early 90s, you had the one superpower, the United States, and strongest economy, forget about the military stuff for a second, the strongest economy, basically conducting affairs globally, and perhaps, and I gather this may have been mentioned in one of yesterday's conferences that I missed in the afternoon, perhaps some mistakes were made. I'm sure there were. I think we can look back at this and maybe some mistakes were made in that second phase. But I think where we are today is really another step on the journey which has been continuing historically, and we are poised to perhaps be moving from a simpler model of unipolar or even bipolar to multipolar. I think that's where we are today. And when I say multipolar, yes, Russia is very important. Europe is very important. Many of us, not all, have historical roots, perhaps at a personal level going back to Europe. But Europe's rise globally, historically, is something that really in the last 400 or 500 years, it's not in the scheme of world history a long-standing story of the degree of influence it had on affairs. And yes, colonialism, when you think about it going back, and then decolonization has occurred in the last 100 years, primarily since the Second World War. But the trading patterns, when you analyze the trade going on, hasn't necessarily changed as substantially between former colonies and other countries, etc. So following the trade and following, for lack of a better term, the nation structuring and the governance, self-governance of a particular nation, we call it, or country or area in the world, aren't necessarily always the same. So I'm going to pause there. So where we are, we're struggling today, I think. Can it just be the U.S. that's sort of the major economy? Or do we have, let's say we were Chinese or Indian. Let's go back to the former Dutch East Indies, Indonesia. When I say India, let's include Pakistan. All of a sudden you've got, just with those countries I'm starting to name, toss in Vietnam, Korea, you're half the world's population.
And I think what's interesting, thank you so much for that history debrief, there's so many things I want to unpack there, and I actually just finished reading a book called The Network State, which looks at how the world is sort of transferring from being this nation state based on military might to a network state based on technology. So I'd love to go further into that a bit later on, particularly with Russia.
Or now. I mean, if you want to, you're driving a bus, but...
Yeah, just a quick point on what you mentioned about the countries, like quietly, and I know there are some people here based in Asia as well, that over the last few years, from a sovereign wealth fund level, there have been quite a lot of interesting JVs. So you mentioned, India, China, Russia. So there's now a UAE-Russia joint investment fund. There's a UAE-China joint investment fund, Saudi-Russia, Saudi-China, UAE-India. And I think not necessarily that they're forming alliances, but there is this bilateral sort of flow of investment. Do you think that the US is maybe missing a trick here? And I think that the comment you were referring to, Prakash yesterday said that the US was handicapping itself in terms of some of the, I think it was in referral to like political and regulatory decisions. But how do you see some of that tension playing out, given that the US, as you mentioned, is perhaps, a pure nation state? How do you see that evolving?
Well, I don't, given the time we have today, I'm not going to advance too many thoughts on the U.S. moving away from the nation state. My own assessment of the U.S. Constitution is, and the values that are stated, the principles that are stated in it is, if there is a model that has the potential for, we're all human, so we all have our cultural backgrounds and everything else, but if there is a model that has the potential reach for buy-in by humans globally, and it's a pretty good model. So I'm going to leave it at that. In other words, the optimist, is that human nature for someone of another culture in a different region to buy into that model? Maybe some of the principles require a little tweaking, and if you were to try and find your global network rule book or constitution, it's not a bad place to start, in my opinion. But I declare that I have a view that whether you live in an absolute state, dictatorship, or democracy, those are all modalities of governing humans in various societies. I think the human spirit, and history has proven this, generally is looking for a degree of independence, which has to be provided with a degree of stability, or things happen. And we don't have time for that. I think on some of the arrangements, the UAE and China, the UAE and Russia, that this was, someone mentioned, this has been going on for some time. The Russians have been courting and developing relationships for well over 10 years, predating 2008 market scenario in other parts of the world, China being one and the Middle East being another, and that region. So I think that we're seeing some of that formalized. We're seeing some of these areas of cooperation being formalized among these states. And is it as comforting to see that as to have an understanding between UAE and the United States of America? Or we talk about India getting all of its military, or the bulk of its military weaponry from Russia. At the same time, India and the Pacific is part of the Quad with Japan, Australia, India, and the United States for defense, strategic defense, military purposes. So I wouldn't jump to conclusions too quickly, is what I'm saying. And your point about the technical stuff, I mean, the internet that we all use, you either abide by the rules or you can't use it. So we're getting some additional access of ease, but we're also abiding by rules to do it. So are you independent? Are you, I mean, if I want to be independent, I don't have one of these necessarily. So that internet, of course, grew out of the ARPANET, which was funded by the U.S. Defense Department back in the 50s and 60s, goes way back for some of us, and developed primarily at its roots to enable effective communications in the event of nuclear arms being used and people being in various situations for government officials and others to communicate with each other. It was commercialized, open for commercialization, back in the late 70s and into the 80s, and of course we've been living with that. That is a tool, and it continues to be a tool where you have outreach which has your nation-state governments wondering how to deal with it. And I think listening to the crypto panel yesterday, among other things, you sort of see various representatives, I think, looking at you saying, well, maybe we can, regulate this and so on and so forth. Because in its nature, it's not regulated. It's, it's the human spirit at work, using some of this technology, which initially was developed for certain other purposes. So in a way, it's almost, when it was commercialized, it's sort of saying, use this, it's for the, I'm going to sound really corny, it's for the betterment. We don't know how you're going to use it, but it takes you beyond borders, right?
Yeah. Well, I actually just read this morning they did the central bank digital currency exchange between Monetary Authority of Singapore, Bank of Thailand, China, and the UAE. So, but it does play into those questions of technology is a tool. It can, there will be good actors and bad actors. How much oversight, with the central bank digital currency, the country still has oversight, right? Versus something like Bitcoin, where maybe countries can't track it as easily. But so almost picking up on that point of technology, you mentioned trade. And I think that's interesting from 2 points of view. You mentioned that the physical trade flows are still the same, but I'd also like to talk about maybe the human capital trade flows and the technology trade flows. But on the investor side, with what we're seeing in trade and some of the supply chain issues, maybe you could talk to that a little bit, and also how can investors prepare for some of what we saw from the results of COVID and the ongoing Russia-Ukraine war.
Okay, I'll take a stab at that, but at some point I am hoping to engage with others in the room who raised some interesting points yesterday, which maybe they can come back on in the context of this conversation. Well, I didn't mean, and I may have misspoken, trade, when I was talking about decolonization, it's just a lot of trade relationships carry on. They carry on for basic reasons, quality of product or service, reliability, price, etc. So, if we, and then in terms of human interaction, intelligence gathering, intelligence sharing, of course there's a lot of that takes place, but there are questions of national security and so on and so forth. And the question at some point will be, is that fabric, that nation structure really adequate for dealing with that? So just looking at trade generally, and as I think Rachel and Michael does, I'm quite involved with the World Ocean Council. Okay, so our whole United Nations, yes, they have a code dealing with the law of the sea, but the whole system of the nation states is a land system. All the countries are, to my knowledge, are on land. And 80% of our trade, you can pick oil or pick something else, is by sea. And 70% of the oxygen in the world, approximately, is generated in the sea. So Brazilian rainforest, very important. But if you do the study and check the numbers, you'll see that we don't want to, in using the oceans for trade or for any purposes, without the oceans, we're not here, right? So how do you deal with that, with your nation states grappling with the sea to ensure trade, security, and so on and so forth? So that would be a starting point for me, which in the bipolar, unipolar, with the strength of the U.S. Navy world, your naval police force was being supplied by the United States of America and U.S. citizens, basically. Does that continue? So to me, that's an unanswered question. If it isn't answered properly, with some understanding if there's sharing of security, of the maritime security to take place, who's sharing and on what terms? And so that is an open question as we live. And that's one of the reasons I said earlier, I think the New World Order it's nice to come up with a catchy phrase, but we are in this mode of struggling to give rebirth to a new order. Who are the players? I think I've given you an indication of my sense that some of the big players, if I were Indian, my first interest will be of India and Indians. If I were Chinese, my first interest would be China and Chinese. So, so can you really have those two, just picking those two for a moment, the very largely populated regions of the world currently structured as nations under our strength? Can they not be part of that equation for it to work? So I think I'm being somewhat rhetorical when I put that forward. So that's an open question right there on the trade. On the COVID, and without getting into decision making, which by both democracies and dictatorships around the world resulted in a lot of restrictions being imposed on people interacting with people. And I think there's a whole generation under, the demographics that we have in this room or at this conference that are going to show us what the results of that are. And I hope not as negatively as potentially that could be. Not going to school, not interacting, so on and so forth. As one of my sons who was here yesterday said, I'm glad I wasn't 21 when COVID restrictions kicked in. So, but food and energy coming out of COVID and accentuated or more highly profiled for us with the Ukraine situation. We have, on the energy side, we have, yes, Russia supplying energy. I mean, you could see this for years, decades, to initially to parts of the USSR Eastern Bloc in Eastern Europe, Eastern Germany, but then by extension beyond to the UK and other parts of that region. That shifted. You have U.S. natural gas predominantly, and more of it being produced at the encouragement of the current administration, but not highly publicized, given the politics of their support base. Most of it's going to Europe. Before Ukraine, that's a pivot. Most of it's going to Europe now. Before Ukraine, that wasn't the case. India has been purchasing oil, which it needs from Russia, but it's a pricing issue too. So if they can get what they need from another source at a better price, and you're Prime Minister Modi, that interests you. So I wouldn't react by saying, oh gee, Russia's getting closer to India, and so if I were Russia, I am trying to get closer to all these and formalize these arrangements, but I don't think we immediately assume that Russia has some undue ability to influence thinking in India and or China and the UAE, where you are. I don't think we should jump there too quickly. But natural gas, Russia has lots of gas. Where are the pipelines? Don't have to talk about pipelines in the U.S. Where are the pipelines? They're all going to Europe. Apparently some of them have had some explosions recently. They're not going to Asia. So if there were to be a pivot, it's a pretty slow-moving pivot to take place. Okay, so again, you have to go from the headline down into it a little more and just sort of step back and say, okay, so what are you saying, Jacques? It's a non-issue. I'm not saying that, but I'm saying to assume that there is not time for the United States and other Western players, Japan and others, many of whom, almost all of whom, have joined in the sanctions, which of course is an interesting exercise, right? Push Russia away, and what do you think they're going to do? Put someone in a corner, what do you think they're going to do? So there's a little bit of that brinkmanship that's been going on. But I wouldn't rush to worry about that. What do I do at York University on the pension fund? Well, we look at our asset mix, first of all. So how much of our asset mix is in Russia? directly. If you invest in Amazon, do you think you're investing in the United States or globally? How much of your Amazon investment have you allocated to actually China risk? I know one of the panels was talking about China risk yesterday. So you don't necessarily, as an investor, have to start overthinking this. And if you analyze and understand your investment, some of your key investment components, you then start to see where some of your risk is, and who's in charge or responsible for the management of that risk. In many cases, is your investee business or corporation. So back to food. Well, food, we're very fortunate in this country. I know yesterday Jim on that first panel was talking about farm ground. I hadn't heard that expression before in many years of farmland and farm ground. And thank you, Jim, for using that expression. But you know, when you think of food security, energy security, you got to go back to the basics. So you go back to farm ground. And in looking at your portfolio, if you're trying to ensure that you're benefiting from stability, farm ground, I suspect from what I was hearing and what I knew prior to listening to Jim, farm ground in many regions of the United States and Canada, southern Canada, that's a pretty secure investment. And then you've got the potential for some, if the price of the agricultural commodity that is being produced goes up, you get a little bit of upside if you've structured it properly. So when you're thinking of stability in light of world affairs, there's some basic, not sexy, basic areas. I'm citing that one as one, to think about in your real asset mix. So one thing we have done at York, and we were doing this before, is we moved away from Canada dominance. What did that mean? Well, of course, 75% close to of our trade for many decades has been with the United States, our most important trading partner and the United States' most important trade. So how much of our portfolio is, in our view, actually, when you analyze the risk, North American risk? Well, you won't be surprised to know that it is close to 60%. And the other 40%, where is that? Well, it's predominantly in the West. But when you start going underneath some of your investee corporations, using Amazon as an example only, not trying to overplay that, you then realize you've already got risk in these other regions, and you've already got benefits coming from that successful operating company operating in those regions successfully. So, so I'm not sure with everything we've discussed that I'd be recommending, I would not be recommending at the York Investment Committee to, I would say, stay the course at this point. There's too much additional uncertainty that you may be introducing by trying to think ahead too quickly with very little data, maybe like some of the regulators during COVID. But there's my dig. But you know, I think we stay the course with what we do know. And I don't know if I've answered your question.
Yeah, no, that does answer. I do have a number of more questions, but I will take questions from the audience as well. That's great.
Do you want to? Do I hear my mic? Here. I don't know. Testing. Testing.
Yeah.
So, thanks for that perspective, and you prompted some thoughts. I want to ask about China, but let me set up that. If I think back to 1989, you took us back to the 60s and probably more best to hide from
Yeah, yeah.
But if I take it back to 1989, Japan, US, we're talking about a trade war, rapid, and so on. As recently as a year ago, pre-Russian invasion, the Biden administration decided Saudi Arabia was on the outs, in contrast to the Trump administration's friendly relationships with Saudi. Yeah. That's changed since. So part of the question is, does the world just inherently have rivalries? And I'm going to China, US. When I think about China, because of concerns about defense, or at least that's the stated rationale, the U.S. government has succeeded in not only banning Huawei from U.S., but effectively getting its allies globally to keep Huawei from
Yep.
building 5G network.
Yep.
So the company we all thought 5 years ago would do that doesn't get to do it. The Chinese government has acted itself against its major dot-coms recently, but even prior to that, they were being denied technology, denied markets because of this rivalry. If I put myself in the Chinese defense establishment's shoes, the people advising their administration, I would look at the U.S. government that led a coalition that took out Iraq's sitting government, that took out Afghanistan's sitting government, and that routinely lodged cruise missiles into conflict areas around the world without a lot of regard to borders. So, I hope I'm a patriotic American, but if I put myself in the other shoes, without trust, I see the nation state that leads its allies to take out other nation states when it doesn't like the government, particularly autocratic governments. So, what's in all that? What's the calculus for the Chinese government to pull back from things like building artificial islands and waving sabers and painting Australian warplanes with combat radar in the Indonesian Straits? What would cause the Chinese government to look like a better partner and less of a threat, so that its companies can be invited back into full participation in the world economy?
That's an excellent question. It's a loaded question too, and I'm not surprised, having listened to you yesterday, that you would come forward with that, Rich. So before I go to thinking it as though I were Chinese, to me it's understandable from a defense and security perspective, with the importance of the offspring and the various devices and how we communicate off of the original ARPANET research. It's not a surprise to me, nor should it be a surprise, I don't think. It's probably a disappointment to the Chinese that that company was not successful in a number of countries, was effectively blacklisted from participating in key communication infrastructure in those countries. So I think for China to truly now shifting to the heart of your question, to truly overcome that, you have to build that level of trust and reliance. And so when I come back to what world order, my words, not, the U.S. is still there, Europe's still there, Japan's still there. I'm just on Japan. No nuclear weapons, but of course the Yoshida, no military play. The Japanese for decades, we're pacifists, so on and so forth. That's all changing, with the strong encouragement of their allies, front and center of the United States of America. And yes, they don't have any nuclear weapons, but they're so advanced on nuclear activity. Do not be surprised if something were to change pretty quickly, and the deck of nuclear cards that they're holding in itself is a deterrent to some inappropriate behavior by their long-standing historical, not necessarily, we would use the term rival, but the history between China and other countries, and that the three kingdoms of China and the other countries, regions. So I think you have to go from the struggling rebirth phase that we're in to the rebirth of, I think it's a full step. To achieve that means there has to be agreement that we now have key players at the table, and it has to be the same basic rules that are agreed to. So I think to actually have China overcome blacklisted defense security economic consequences or limitations coming from defense security blacklisting decision making, there has to be an agreement on the rule book. U.S. football, Canadian football, 110 yards playing field, 65 yards wide. 55 by 100, I think, or 110 if you count or 120 if you count the end zones in the U.S. 4 downs, 3 downs. So you can't have that. for what you're playing the game. We can't play the same game on the same field. We have to get on the same field, 11 men, not 12, Canada, 11, 12, 11, 12. It could be 12. But you see what I'm saying? You can't have that much uncertainty and rely, you don't have to accept my opinion, in fact, I'm not, that the nation-state governance structure, with the possible exception, in my opinion, of the United States Constitution providing components for humans around the world to then look at that and say, maybe it's not identical to that, but we got the basic principles to make something work globally, which has to cover the oceans, the whole environment. I think they're going to struggle with defense security issues until such time as they're trusted. And I think for them to be trusted, they're not, if I'm Chinese, I'm not going to just sort of go ready to the President of the United States. It's not in the cards. So there has to be an agreement, or I call it a handbook, something that says, yeah, we're agreed, and this is what we're going to do. Look at the United Nations, just as an aside, if I may. Look at the United Nations set up post-second. Who's sitting on the Security Council? Does it make any sense? I mean, that's just a slight, and I'm not knocking I'm not saying crash it or anything else right now. I'm saying maybe it's time to look at it. It's like anyone who's looked at corporate bylaws in your company or looked at, or in the pension fund itself, you know, look at the bylaws set out in the university's arrangements with the pension fund. You got to take a look at them from time to time. It's time. Those facts that led to United Nations and all the stuff we were talking about, in addition to getting under our desks when the sirens went off in the 60s, those facts have changed. I don't know if that answers you. I'm not trying to skate it. I just think you got to take the full step.
I love your answer, especially the football metaphor, although I think we're not even that close to football either. And then you make a great point about the security.
Yeah.
Do you think as a United States has a problem with all non-democratic countries? Wherever the democracy doesn't exist, or let's assume wherever there's a communist country, US has got a problem. All the communist countries in the world, US has got a problem. Wherever there is an autocratic style, US has got a problem. Historically, you take 30 years or 50 years. Do you think wherever there is a non-democratic system, US got a problem with those countries?
So if I've understood correctly, is the question, do I think that the U.S. has a problem, so structural, endemic, with non-democratic?
They're pointing to this, what's a problem with others. In China, they're saying China has a problem. The problem may be, there's a simple saying, when you're showing a hand like this, and one finger is pointing you, the other finger is pointing me. So there may be some problem with the United States mindset, just thinking loud.
Yeah.
Because it's not necessary that I have to correct all this. So every time when I find a fault, and all the faults whatever has been found in Iraq or Syria or in Iran, you take any countries in the world, in the Eastern territory, Southeast Asian territory, Cold Russian War, in the US-Russian War, anywhere in the world, or South American countries, Cuba. So everywhere where we map the top 10 biggest US differences, they came from whenever they are non-democratic. In those countries, the countries are non-democratic by nature. Where
Yeah. Well, I think, so you raise a good point. So and a tough question, another one. I don't know if we can allow these two to sit together. But let me take a stab, because my wife is American, but I'm not, and I don't pretend to speak for her. So I think the genesis, my words, and I'm so stand to be corrected, the genesis, a number of the value principles that are embodied in the United States Constitution And of course, there's a written constitution, and the question is, how is that evolving in America, you know, among Americans? I won't go there, except to say a lot of it is rooted in liberal, and I don't mean liberal left, liberal entitlement to my own faith, entitlement to my own private property, entitlement to a principle of Jean-Jacques Rousseau. You know, if you're part of society, you limit your freedoms to the extent that you harm or injure others. You're not, that's not on. You're going into the community, you're going into society. You must forego the freedom that you would have if we were all outside in the woods and you had something that I wanted, and I just go and say, give it to me, or, you know, or else, right? That's not, so a lot of those, what I call liberal principles, civilization principles, are at the heart of the value principles in the U.S. Constitution. And then there's democracy, which is majority rule, and majority freely expressed rule, not coerced, but cajoled, encouraged. All of that's fair game, but not coerced. So that's what you have at the heart of that, the way I understand it, of those, and they're evolving, they're being debated by you and the Americans here. And so that's great, that's all fair. So now you have something else that's different, and you really believe in those values. So I think there's definitely, you know, a question of, am I an American, the United States, am I on the right track or the wrong track? So there may be that component that exists, which is my track is better than your track. To then take it to the next step of fear or concern about your track. So the question, is the United States a missionary for the United States of the world? There may be a component of that on the first thing I said, okay? There may be. Again, we're really reaching now. That last question that you have on the list, we got to throw back to the room and start with that table. But the point I was going to try and get to is, yeah, it's different. It's different to values that people have bought into, that in many cases, not every case, people have enjoyed, and this country, the United States of America, has enjoyed all this growth and prosperity. And yes, there's still poverty, there's that, and I'm not saying it's better than it really is. I'm just saying you have all of that under this agreed handbook or playbook. So if someone has a different playbook, are they, let's tear it down and replace it with our playbook? There's a little bit of that. But I think at the same time, the U.S. administration invited China to play. And people forget that over time. They weren't playing. They weren't really being invited. They weren't trusted enough to play. And the United States administration said, let's play. Now, was that devious? Was that to say, oh, well, you're communist, but actually, if you free up your economic principles, and this came out both in your statement and the first panel yesterday, you know, are they mismanaging their free economy or freer economy or non-centrally planned, or do they still have the central planning to be in certain positions? You still have to be a member of the Communist Party, blah, 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 right? But at the same time, there's a degree of, I don't want to use the term democratization, it doesn't apply economically. It's a degree of independent or decentralized economic decision-making that is encouraged and supported. So what's going on there? I think it's still an experiment. So that, I'll pick China for one. I think, oh, but now China's almost as big, the economy is almost as big as the US, and China wants to play, you know, they're wearing long pants now. Pardon me for the male expression, but, you know, they're not in shorts anymore. Okay, so how are you going to deal with that? So you're asking a question, I'm almost throwing it back to you. How are you going to deal with that? Are you going to play? And I think, in a way, you're getting back to my attempted answer to Rich, which is, you need a handbook. Are we going to play with 12 men on the field or 11? What's the field size? You know, what happens if I miss a field goal? Do I kick off after a field goal? You know, are we all agreed on certain basic rules? Then we can play. Otherwise, you can't really play.
Okay, we're going to take 2 more questions, and then we're going to throw a question back to the audience.
I'm going to pose. This is a different kind of question. I spent most of my working life living between Japan and Micronesia. And so I saw the world from a different perspective in terms of seeing how powers play. I mean, for example, like Micronesia actually, the independent countries are actually agreeing to say the states, which pretty much was military right denial in place in terms of fishing and things like that. So I say this, I kind of have a point of view that we actually still live in a system of mercantilism, and that the place where we see the stability you saw before, let's say bipolar U.S. versus Russia world, that was based on a mutual assured destruction, but also an equal mutual benefit. And I think from the standpoint of forced ways to do this, we have to acknowledge there is a military aspect. Like the reason why your ship can get from A to B and not be attacked by pirates is because there's an understanding of the responsibilities. And I think that we live in a world in which there's kind of a superstructure of imposed order. And I think that for us to have the balance we want to see in this new world order, that we've got to actually look for how both sides can benefit and how we almost make ourselves essential to each other's reality. Is that it's essential for me to win as much as it's for
Yeah,
you.
yeah.
That's again, if you go to say, take the China case, if you were to say, look at, let's say, at trust models, you know, we operate with, say, a culture of trust based on contracts as opposed to one based on mutual benefit. And I think if we want to engage with cultures that are based on mutual benefit, we've got to, I think, join them in this culture of mutual benefit. And I think that's ultimately where we have to go. Like, again, I mean, like you see in these areas, I just think that there is, I see this living mercantilism, so I still see it as the way of, let's just say, the economy, just from my life experience. We live in a nice bubble world where we don't see the spheres pointed at each other, but for most of my working life, having lived as worked in a lot of small countries throughout the world, I see it as a much more powerful versus not powerful, and aligning with powerful, and I see a lot of regional things, and so I see in this case with this change that ultimately for it to work, we can't look at imposing something on someone. We have to look at how we're going to create a mutual beneficial relationship between each other and have that actually work.
Well, and I agree. I think that I agree with your observation and the conclusion. Interdependence, for example, in it's forgotten the acronym, but of Islamic countries, you know, there are very few that are secular, which is what you're more accustomed to. You know, your faith is there, and this is a secular government. That's a possible exception of Turkey. I mean, you really don't run into that. So, mutual economic benefit is a starting point that should be encouraged. I agree, and I think the handbook, if the handbook reaches in, this sort of touches on your observations and the first two questions that were raised. If in that handbook you get down to how you deal with minorities in your country and how you deal with this and that, you got a problem, because you're not going to agree that handbook. That becomes more today with immediacy accepting certain governing principles that culture and that country, that region is not ready for, and may never be, frankly. So do you not trade then? Sorry, I agree with you.
Thank you, Doc, for your perspective. You went back about 80 years to World War II. I want to go back a little bit further.
Sure.
I have written down my questions lest I be proposed. We're 13 years away from that sesquicentennial anniversary, that meeting, the Berlin Conference. And so I have 3 questions to ask. The first is, can America survive the Belton Road initiative, which is the Berlin Conference 2.0, I would say, but headed up by one country in particular? Number 2, why don't we extend our presence on the wealthiest continent in this galaxy that's known to man, which is Africa? We only have one military base, and that's in Djibouti, and that's Air Force. Only one military base, about 52 countries. Our exposure is nil. That's why Belton Road can survive there, I believe. And thirdly, will it be too late, i.e. Charles Deming in Japan? You mentioned something in the first 2 minutes about Japan almost taking over. I think they've taken over our automotive industry, and thanks to Charles Deming. and his, spectacular engineering in Japan to bring them up out of the ashes, per se, figuratively. And how will the Marshall Plan look for Vladimir Zelensky's Ukraine if they can survive? That's a fourth question that side, but the three, first of all, Belton Road, existence, our presence in Africa, and because that's a national security piece as well. Let's not forget Cuban Missile Crisis, Russia 90 miles from our back door in Miami. So strategic location of assets is quintessential to any piece of warfare. Anyone will teach us that. I'll turn it over to you. Take it away, please.
There's about an hour's worth of answers, so maybe we just...
I think I can take a quick stab at the Belton Road. So the Belton Road, if progress is not made, in my opinion, if progress is not made in the next substantive progress on agreeing levels of agreement with respect to maritime security for transportation of goods, where there is agreement doesn't have to be full agreement, but of enough rules among some of the key players, and China would definitely be in that category, and I would say India as well. Singapore, as you know, is strategically located right now, so you're easy to deal with sort of certain transportation. But I think you need to have people at the table. If they're outside the table, if I'm American and I'm feeling worried about anything, imagine if I weren't at the table. Then I'm even more worried, in my opinion. So I think if that substantive progress does not take place, I'm going to say in 5 years, because the Belton Road will continue those discussions. But the Belton Road is not something that happens overnight either, by any means. And it's really, the driver of it is to go back. We're not going back. The world is not going back. You learn from where we come from. You go forward. So I'm not someone who is really worried about the Belton Road or thinks it's going to be successful, because I think that I'm more optimistic that there will be some agreement on naval or maritime policing for trade purposes. Back to the observation of your colleague just one desk in front of you. He said mutual cultural benefit. I'm going to, for today, take away culture, not to take it away, but just focus on economic. If you and I are trading insignificantly, and I think we have a degree of, yes, with the supply chains, there'll be some companies that need supply locally. That's with the computer chips. What happens with Taiwan? Well, also, meanwhile, what's been going on for some time is other computer chip manufacturers and other businesses dependent on it are gearing up in other locations, including this country. So you do all of those things, but if we have clear economic interdependence, which means that if you take me out or I take you out, we both have a problem. You got a serious one too. Then that's a good way of saying, okay, stop. Now I'm going to date myself again. Buffalo Springfield, for what it's worth. Stop, listen, look around. And I think that's where we are with China, my own opinion. Yeah, there's the media and this and that and administrations. I think there's a good chance that in the next 5 years we'll have some cooperation. I think the U.S. will still be in the lead, but there may be some cooperation. And by the way, in those waters near the China Sea and the Japan Sea and so on, Japan will be in the mix. Japan will not be in the mix. So you'll all, by definition, you're going to have a lot of eyes watching other eyes. Okay, does that help? I don't think I can go into the other ones. I think we're out of time.
That's excellent. I just don't want America to be another chapter in the great book, The Rise and Fall of Great Powers by Kennedy. That's a great read.
Yeah.
Byzantine, Ottoman, Turk, British, all Roman.
Yeah.
They were at now right at one point in time in their lives. Where are they today?
Well, remember, the United States has come at it based on those value principles. So people talk about the U.S. empire and so on and so forth, but look at the facts. Look, even the strong-arm tactics, even the knocking over governments and so on and so forth. Look at the way the U.S. has been conducting itself historically, and you don't see, in my opinion, the empire equivalents, with the possible exception of parts of the British Empire. I mean, where they were, but I think you're operating on a different model, and I think it's, as I said earlier, it's a model which has the potential to get buy-in, not as is, but buy-in if we were thinking of how do we govern this planet. Now I'm really reaching.
All right, I think we're going to have to end the discussion there, but if you have any further questions for Jacques, you will be
I'll be
around
here.
at
Yep,
lunchtime.
I'll be here.
So we
Yep.
can follow up on those. And just thanks for all your questions, and thank you, Jacques. That was a
Thank
very
you.
interesting conversation.
Well,
as always.
we're still expecting to hear from this table right here about the investment opportunities of the businesses that we should be investing in 2050,
Oh,
right?
yeah, there was a question, which nations will come out
So we
better?
punted that to the table in row 2.
Which countries will come out better economically and politically in 2050?
I'll go to markets. I'm still a China bull. I'm trying to figure out the path that we get there and would want to diversify. I mean, better. Sorry. So I was going to say I'm still a China bull in terms of market valuations and where I place client assets. I don't know the path that we get there. We always have to diversify. Asking which countries would come out better, I'm just going to take issue with the question. Your trading partners growing their GDP fast is awesome. I mean, we shouldn't, nobody in the U.S. should sit here and say 10% GDP growth is bad in China. If we're playing by the same rules, if we're trading, the rest of the world growing fast is a wonderful thing. And would mean they can afford things like carbon mitigation and hurricane catastrophes down. So
you want me also to answer?
Absolutely.
To penalise you for your difficult question.
So, I will accept the rich perspective. Because China has got a lot of domestic problems. Currently, it's a controlled environment. It's not known globally. Being traveled there and did business there, 15, 16 years of experience on the Chinese side. It's still, they have their way of doing things, and they don't want to change it, and they're very clear on it. The next 6 years is going to be very, very critical. If the existing premier come back and he exists for the next 5 years in the region, it's going to be a more autocratic nation, hardcore autocratic nation.
Mm-hmm.
Even though they are communist by nature, but still there's a little bit of a process of electing the premier. But that they're trying to dismantle the whole existing system and making him to continue. That continues. Because at the end of the day, it's all about people. The leadership is all about the people, how they think, how they want to see the world, and how they want to narrate the story to the people. It's all about people. So that leadership. So next 6 years is going to determine a lot of things in the world, specifically when it comes to China. And there's an opportunity, if you look at 2050 map, India can come out of something very big. But the problem also, India has got its own problem. But comparatively between, if an Asian map, if I put the Asian map, it's an opportunity for India to come out of something great out of it. We are still 1/10 of the US economy. US economy is $2.25 trillion. India is still only a $2.53 trillion economy. So it's 1/10. But giving it 30 years roadmap, there's a huge opportunity. That's what I look at it at this junction.
Okay, well, thank you very much. Sorry for putting you on the spot, and thanks again, Jacques, for your time. Okay, and we've spoken a little bit about ESG over the last day and a half, and our next panel will be doing a deep dive into that. So to discuss a deep dive into sustainable real assets and new frontiers in ESG, I'd like to welcome the panelists to the stage. Thanks, Sharon. We have Avantika Saiska, Managing Director, ESG Integration at WAFRA, Dale St. Clair, Chief Strategist, ESG Investments at Amalgamated Bank, and it will be moderated by Chris Snook. What's the best title for you?
Yeah, there you go. That's it. That's the title. The name is the title.
I'll sit here. You know, I've got that space thing. As we learned. Thank you.
All right, now you got to save a couple brain cells. That was a bender, that one. Well, tough act to follow. So super excited to be here. That was amazing. I hope I get some time with you on that conversation after lunch. We're going to shift gears. I like to disclose bias whenever I talk. If you haven't figured out from my question just today, I may have one. So the best way to do that is to kind of kill two birds with one stone, which is the quick kind of visceral who we are, what we do, and the lens we look through, and so that you know who you're listening from. And as we frame this debate, this discussion, those things are kind of obvious, and we can get kind of right to the quick of things. So I'll start just as a quick example, and then I'll go to my two brilliant collaborators here, Dale and Avantika, and then we'll just get right into it with a couple questions. So the bio says a bunch of things, but the reality is I've spent 22 and a half years as kind of an entrepreneur. Before that was a glamorous thing to be.
Really?
And I tell you know, my Gen Y and Gen Z mentees and friends and things all the time that it is not a glamorous life, but I have found deep meaning in it. I've been an investor. I've been up and down a bunch of different times. I've ridden through 3 different cycles, so I've got, you know, enough dents in my forehead and used to have hair to appreciate the sober and pragmatic and kind of thoughtful approach that we just listened to, which is kind of a gear shift from my normal MO. So I spend my time a couple of ways. I'm a global investment strategist with capital allocators, insurers, and people that are essentially trying to understand where the market's moving as it relates to deep technologies. I have a foundation that supports grants and gives away and does a fund competition for AI, IoT, blockchain-related Web3 technology startups that are earlier growth stage. And then the rest of my time is basically just figuring out what I'm interested in next and being curious. So my full-time kind of charter right now with at least the next year is growth partner at Climate Alpha, which we'll talk about because that's related here. But Climate Alpha is an AI predictive valuation platform that powers 40,000 different zip codes right now in North America, Canada and US, and soon by Q2 of next year globally. And it allows asset allocators, asset managers, developers, or insurers to look at climate risk in 100 different proprietary data sets through an algorithm. As of right now, our clients have been able to see a 10% increased return on assets and a 70% increase in total appreciation through 2030 is kind of the predicted model. But they can model out scenarios, forecasting. They can use Alpha Finder to figure out where they should put their next development. So that's my lens as it relates to kind of clean tech, ESG, and those opportunities. Let's start with you, Avantika, and go right into it.
Hi, everyone. My name is Avantika Saiska. I'm the Managing Director of Sustainable Investing at WAFRA. We are an alternative investment shop. We manage around $33 billion here in New York. We're also owned by the Social Security Fund of Kuwait, although most of our investment team is based here in New York City. My job and my role is really to look at ESG integration in due diligence and value creation across our alternative asset classes. So our team sits alongside our deal teams. We're looking at actively what are the ESG risks and opportunities we want to underwrite for every deal. And throughout ownership, how can we ensure long-term value? Prior to my role at WAFRA, I started off my career at Northern Trust Asset Management. I was an equity strategist and quant strategist. We had many European investors asking us about ESG at the time. So created around 13 different products, managed around $70 billion, mostly on the equity space before coming to WAFRA.
Thank you. I'm Dale St. Clair, and I had the privilege of starting my career at New York City Pension Fund over 25 years ago. And I say that because it's framed my entire career, starting as an ERISA allocator at New York City, leaving the city to form Williams Capital, which in 2001, today Williams Capital is the largest women and minority-owned broker-dealer investment bank, mutual fund platform. That's my colleagues. I built the infrastructure and exited in 2016. And I exited a successful business because I wanted to do a deep dive in tech, thinking that this decade tech is across every industry, as we know, and also wealth management. So today I wear asset/wealth management allocator hats globally and focus in fintech and enterprise risk management. And what does ERM mean? It's where I started 25 years ago, which is really the core of ESG in my view, and the seats that I have and have the privilege of allocating other people's money.
So, through the lens of the best movements, the best companies, the most appreciative stocks typically solve a big problem. Through that context, what is ESG for each of you, in your own words, and what problem is it really solving? Should it really solve? Frame that however you'd like. Let's start there with what it is.
Can I go first? So I think we look at ESG very much in that investment-led approach. We're looking at environmental risks, so that could be long-term risks like climate change. From a company perspective, it could be toxic spills, waste efficiency. On the social side, we're looking at labor rights, supply chain, diversity. And on the governance side, we're looking at the governance of a particular company. Have they been involved in any corruption, scandals? Have the board been, involved together in a long time? Are they independent? And what that really does is inform us from a long-term perspective. Do we believe that there's any financial or operating risk as us being long-term investors? And so I think from that investment lens is really where we play. And as a team, the way that we're structured, we sit under the CIO's office. That allows us to really have access to investment committees, participate on deals, and that's really where the bulk of the decisions are made. And so from an ESG perspective, when we're brought on a deal, I think the majority of the time we're really looking at that long-term risk perspective.
Thanks for starting there, Chris. Not everyone leads a panel and starts back to basics, and it's a critical question for us at Amalgamated Bank. We look at it both as an investment perspective. Our AUM is $18 billion. We also look at it as a business perspective. Amalgamated Bank is America's first socially responsible bank. It was formed in 1923. And having grown the institution from a social responsible perspective, I'm using names and labels, but the genesis has not changed, even from 25 years ago at New York City. So is it ESG? Is it SRI? Is it, we know what the acronyms are. The critical element, and as Chris astutely started, what is it? So for Amalgamated, starting and being focused on both business and financial returns, and using that terminology, doing well to doing good, that is across the environment. We do focus in water and climate. We do on the social side. We do focus in, and actually this is where D&I, diversity and inclusion, comes in, as well as in governance. It also includes cybersecurity, and from the standpoint of crossing areas with other elements on the social side, that S and G are closely aligned in that respect. So from the standpoint of where we sit, how does that impact our balance sheet, where 80% of our investments is directed in the community and directed in the environment and directed across ESG? That leads us to rank in one of the top performing small cap financial institutions. We're NASDAQ traded, and that's across the universe. So I always talk about the universe, because the reality is, can you invest and have financial returns? We all should be compared by the same benchmark. So whether that, and we obviously institutions and investors got to determine what that is. But that can be the S&P 500. That can be the Russell 1000. And yes, we've demonstrated that you can invest with an ESG lens and be competitive in the broad market universes.
So then, great great context around the definition. What are the challenges that you see in your own organization as it relates to current market ESG, politicization or whatever it may be, and or if that's not relevant, what is the broader impact you think you each could have on the ESG category / movement / form of new metrics?
Well, I think probably answering to the latter part of your question, having ESG sit alongside the investment team really makes all the difference, especially in alternative markets where ESG is looked at sometimes as the check the box, sometimes it's consultant-led where you get one tear sheet and that's in your investment committee documents. We really look at ESG as a long-term investor. Being owned by a pension, it's extremely important to us that we're taking that long-term view. We're looking at climate risk as physical climate risk and transition climate risk. So physical climate risk is the weather around us, flood risk, hurricane risk, wildfire risk. These types of risk you can't really look at historically, right? The past looks nothing like the future. If we're on a 2-degree or 4-degree scenario, we need to be taking that into account in the way that we underwrite our real estate and real asset deals. So is Miami going to be underwater in the next 20 years? Maybe that's something we need to look at. I don't think 10 years ago anyone thought Fort Myers was going to look like the way it does after Hurricane Ian. And so as long-term investors, we need to ensure that we're not going to have stranded assets. We need to ensure that our assets are resilient. So whether that means ensuring that we have the right type of panels for windows, we ensure that it's wind resistant, we're investing in locations that are not going to be hit by these severe catastrophic events. That's something that needs to be discussed within investment committee. It needs to be discussed within the due diligence process, and it really cannot be addressed during ownership. So having ESG really starting at the get-go and then moving throughout ownership is extremely important to us, and I think is definitely a challenge within alternative markets, which is sometimes newer. ESG is newer to alternative markets than public markets, which it's been around for over 10 years. But there are active conversations that are being happening in the alternative investment world.
Anything to add?
So putting my private market hat on, and that's the area where we can invest both directly and through funds. The ESG framework that we use is the same. That it has a similar framework with different components in the public markets as in the private markets. To the standpoint of having an ERISA hat on versus a wealth management hat on, where your mandate is driven by your client or the family office. ERISA clearly is driven by rules and regs that are specific to pensions. The question goes back to, can we invest with an ESG lens and adhere to ERISA rules and regs, which is part of the topical conversations that we are all reading about across states in the United States. So it goes back to, for us, and frankly for most investors, having a definable framework, defining which of the, we use the UNPRI as a base, so which of the 28 do you follow, and most of the hats I wear, it's 9 or 10 of the 28, not all 28, and then having the framework around discovery and measurement and reporting and ongoing monitoring. And with that as a framework, that drives both public market allocations as well as private market allocations. And the good news is that with tech today and the multitude of sources that we have, and Chris is at one, but the multitude of sources that allocators have to help drive their intentions in their portfolio, that's the beauty of evolution and innovation. Is the tech around ESG matrix today?
So the way that we would think about that, and I think you bring up a really good point, and it drives back to your kind of laying out of environmental risk and social risk and governance risk. So I'll try and tie these things together. Is technology is really good at doing things that humans can't do as fast, but it can't be human, right? And so I think what's interesting is when ESG is sitting next to the investment committee, right, you still have to drive some kind of alignment or refutable alignment, otherwise bogged down, missed opportunities, risk, whatever. So how do you do that? And what's the tool set? So, you know, what we deliver and what we work with is the tool set side, right? How do I create a robust, deep, data-driven, multifaceted document reporting structure, forecasting, and justification, for lack of a better word, so that the ESG can look at it and say, oh, yeah, we're going to divest our 500 unit multifamily 55 and up in Orlando or Fort Myers, because over the next 17 years, whether we think that's underwater or not, the heat is likely to get worse. Our aging population may face more heat deaths, more the social impact of owning that property. The financial interest may or may not be worth more or less, but when you factor these two things together, you can come up with a number using the same tool set. And then the governance of it says, well, wait, where are we going to put the next one? And so then using something like an alpha finder to find, is it Ann Arbor, is it, where is it, right? Is it Indianapolis? And now justify that the investment you're making in real assets or sustainable real assets touches on those three components, because now we're putting people in a climate that's a little bit more temperate, more climate resilient. We're putting a real estate asset where there's going to be someone to hold the bag when we're done and we want to divest it, and it's not going to be something we have to take to zero, which we talked about yesterday. So I think, you know, that's kind of the interesting thing, is where do you see good examples of that, or where have you already kind of in your own way, you know, driven irrefutable alignment around your team?
Yeah.
What have you learned in that process?
I think you brought up a good point where software as a service is a very big industry today, especially around ESG. So obviously ESG consultants have been around for some time. It's a very fast growing industry, but most asset owners don't want to just see a consultant report in an IC deck or a consultant report on the side. They want to see annual reports that show that you're tracking metrics. And a lot of that relates to the fact that asset owners have their own goals. They have goals related to carbon footprint, whether they're net zero commitments, whether they're impact commitments, and they want to hear from their asset managers, where is my capital going to, and how are you being a responsible investor to track that capital over time? And that's where software is extremely important. You know, I'm not on the ground to every investment to look at, you know, energy meters, but there is software today that connects to my utility company for every building that we own and gives me real-time data on the amount of energy we're using. There's also AI software that allows me to better understand when do I need to turn my air conditioning on in an office building and when can it start powering down based on the population that's in the building at a point in time. So these type of software allows us to be, one, obviously more efficient, which is great from a cost-saving perspective, but two, it allows me to be a very responsible investor to my asset owners who have their own goals, whether it be carbon footprinting or impact, and want to see, you know, their asset managers taking a step in that direction.
You know, on that level, some people may have seen what AutoCAD recently kind of announced as far as their Web3 and some of their kind of three-dimensional spatial web stuff that they're doing and integrating with Unreal and some others. But to that point, even the design of a building, right? Now leveraging AI, I can look at 10,000 different ways to run a hallway and a bathroom set based on use cases of what that commercial property is going to be most used for, and optimize against, you know, everything from traffic flows to energy flows to climate, you know, AC temperature drops. Yep. So these things are all there, and they help create justified, you know, things. Let's shift gears a little bit, unless you want to pick up on that one. But I want to shift gears to kind of the second half of this, which is
I am going to pick up on it.
The IRA. Yeah. So then pick up on it and then shift gears.
Tie it to your next question.
The next tee up after you pick up on that is how does the regulatory framework of IRA and what's in the EU, which are different, how do they shape that problem set or that opportunity set for you all? Because you have to kind of look at things in a new way now, given the amount of commitment that's been made to clean technologies and other things that may augment or support your portfolio. So I'll let you handle that after you
thanks,
pile
Chris.
on.
Chris and I became fast friends yesterday, so now we we get to share what we shared last night with you all. So thank you for that question. Tying in those two remarks, we use at Amalgamated Bank both internal and external vendors. Is at the end of the day, we know what our goals are, and then we have our time frame and to execute that, and sometimes it takes a combination. So we've got a great digital team who's spent a couple of years making sure that every data point to every dollar that Amalgamated spent has a tracker and is associated with a hard result, so that we're able to say with confidence over 75% of the bank balance sheet is directed into the community. And that when I say community, I'm speaking about from a national footprint, which obviously drills down to cities and towns. We do use a couple of sub-advisors who have great tech that they've built, and towards that end, I can now take the seat that I had 25 years ago and match that to today. So at New York City Pension Fund, that was a time when one made a decision to exclude certain elements for, in the case of New York City, for New York City Fire, Police, and Pension, and back then some of you may remember or read, investing in South Africa. Many pension funds elected not to back in the 90s, 80s, and before. Today, and agreed to and understood that was going to impact their financial returns. Today, at Amalgamated, we can execute exclusionary practices around ESG that we have defined and are transparent with, and use technology to replace what we've excluded, so that the ultimate outcome matches the benchmark that we determined. And that is a fantastic and really sort of humbling situation to be in, because now we are executing with market returns and putting forth our ESG lens in a manner that is consistent with our investment policy and stakeholders.
Sure.
Talk about the regulatory environment that we're in, and post IRA, whatever you want to vamp on there. And then we'll go to you guys for more questions, because I'm going to pass the mic. So
I think the regulation environment is very interesting right now. So in the US, obviously we have the Inflation Reduction Act, the IRA, which is a historic and monumental act for really everything along the value chain as it relates to decarbonization and renewable energy. You have $30 billion going to tax credits for manufacturers of solar, wind, carbon capture. You have $20 billion going to EVs, and even $2 billion going to retrofitting auto manufacturers already. So everything, what the U.S. has done really well is provide an incentive program for private investors to really say, this is where you need to invest along the value chain to get towards decarbonization and our reduction of the Paris Agreement. And we'll provide incentives along the way, which as an alternative manager is great, because then, it's the breadcrumbs that lead us there. But in Europe, that's very different. In Europe, it's very expensive if you are not a sustainable investor. If you are a metal and mining company, if you are in real estate and you're not recycling or disposing of waste correctly, there's a tax to that. If you are a high greenhouse gas emitting company, there's a tax to that too. It's the carbon tax. And so in Europe, it is not affordable and not economically wise if you are not a sustainable company. And so in that sense, you have kind of a two-pronged approach of what's happening across the pond and what's happening here. Here being more of an incentive program to allocate private capital towards those initiatives that are going to bring about decarbonization. And in Europe, initiatives that are, you're going to get taxed and penalized if you're not looking at sustainability. And to that end, because there's so much capital flows within the European market towards ESG, they've taken a more systematic approach of defining what is ESG and what is decarbonization. So if you've seen SFDR, that's where if you are an asset manager and you want to market funds in Europe, you have to openly disclose what level of ESG integration are you doing. Are you not doing any ESG integration, which would define you as an Article 6 fund? Are you integrating as an investment process, which is Article 8? Or are you doing impact investing, which is Article 9? They've also gone so far as to say, what is green, what is sustainable, what does ESG mean with the EU taxonomy? And so if you are a fund or you're an asset manager marketing in those areas, you have a very clear parameter of if your fund can be considered sustainable or not, which today I think that's where the IRA falls short of, is providing a very strict definition around ESG. You know, obviously the SEC is doing other standards to pass along more transparency, but they have stopped short of providing an absolute definition.
On that point, Dale, I know you have a lot on this too. Texas and Florida, nothing to look at, much to do about nothing, meaning like just political footballing and grandstanding, or potentially a significant constraint issue to, you know, stall. Like, how do you, when you think about, you know, that limitation, is it, where does it sit? Is it important? Is it not something? Is it just news?
Well, ESG has always been politicized, I think. You know, in general, it started off with the screening approach. Do you screen tobacco companies and alcohol companies? Do you not? I think right now it's getting a lot more traction given the primaries and states kind of saying, leaning towards more Republican standards. As an alternative manager, having LPs on both sides of that, where you may have, you know, a Texas pension alongside a Nordic pension, it is very difficult to find consensus. But I think they're working together much more than maybe the media gives them credit for. I think they just probably don't want to show, they may not be the first in line for a decarbonization fund, but if you say you're looking at climate integration and you're doing it from an underwriting perspective to ensure long-term value, that's something that they understand.
So I'm going to interpret your response as it's noise and political head faking until November, and then it'll not matter.
I think it's
may be too
noise.
general,
Yeah,
but
I think it's noise, but I think ultimately, you know, these are long-term investors. They want to understand the financials a part of it, and ESG is only as good as, you know, making money for long-term investors, right?
So you don't feel the risk, and you don't have to answer this if you don't want to, but I'm going to probe. You don't feel the risk with your LP sets of that polarization. Like, you don't feel that as something you have to manage or mitigate outside of just being empathetic and trying to create synergy, or is that something that you do kind of war game out and go, you know, we make a stand this way because it's what's right for WAFRA or whomever, amalgamated, and we might lose LP X, Y, Z?
I think there's a very important distinction between what is feasible in a fund and what our LP's goals are. So if we have an LP that has a net zero commitment and they're pushing me to do carbon footprinting, and I have another pension in that fund that may not want to pay for it and the fees may not be able to transfer back to the fund, it's important to understand, what is this fund? Is it a co-investment deal? Is it a secondary deal where if we're not a sponsor, I'm not going to be able to get that type of information? That's something that in the alternative markets, that type of collaboration is much more present than if you are in the public market space and you have to do something. And so there's much more dialogue, I think, from pension plans and obviously, you know, lawyers and legal firms who are at the precipice of this conversation to find consensus. And ultimately, you have to do what's feasible for a fund. You can't really just add the additional cost if you're not going to be able to grab that information.
Everything to add, or should I take some questions?
Let's take some questions.
Who's got a question?
I mean, I have some thoughts, but I'd rather make sure we get to questions from the audience.
We'll go all the way back and then up to the front. Pass the baton.
Can you turn his mic on? Or maybe you can hear, but it...
A little bit
Kind
better.
of.
Yeah, that's fine.
I think that was it. Yeah.
That's fine, yes.
Mic is not on. Read.
The one on disclosure, every reporting company will be similar to kind of a Sarbanes-Oxley implementation, which is incredibly expensive for every company to put in place.
You're saying the cost of
So
the...
the question is around
ahead.
cost, right? So in other words, with the three proposals the SEC has laid out, regardless of which one may get cemented, and if all three get cemented, yeah, so if all three get cemented, is it the Sarbanes-Oxley of 2022 is what is essentially the generic, like cost analysis question?
I think that's a very important question, and I will take off the amalgamated bank hat for a moment, because I grew a small business, and today that small business can afford that because of the size that they are today. But there are a lot of small businesses that cannot, and that must they're SEC RIAs. So I certainly. I do believe there's going to be, obviously I don't know what the outcome's going to be, but we're all working with a degree of some guidance in terms of how we work today. There's going to be an implementation period, an evaluation period, and incorporating that cost into how running the business may involve partnerships. I mean, there's always a solution, but it's certainly a great question from a small business perspective. Many allocators are, go ahead.
Sorry, the entrepreneur in me can't,
Yeah.
this
No,
is the way
exactly.
my
It's
crazy
big,
brain
it's
works.
huge.
So I'm going, okay, so if they pass that, then I gotta go find the Avalara of ESG reporting.
Yeah.
Right, if you know what Avalara is, they built a $1 billion business basically
Exactly.
solving the sales and use tax automation problem for everybody, right?
Right.
And once you implement it, they never stop doing it, you can't take it out. It's a brilliant business model. So software could potentially be a way to offset cost mitigation and also create a whole new category of SaaS, which we were talking about earlier, but that's not relevant. I just think if it happens, there's always a way out or profitable that could enable it and make it justifiable.
And investing in
RIAs
venture,
and others.
so investing in venture capital, that is, which I view as small businesses, frankly. It's not just managers, but running, focused on in the venture community. That is where the results will be hit harder. But it's also the community that is, with respect to tech, that we're already seeing some solutions, or at least in the incubation stage of businesses that may be addressing that in a more cost-effective way using some new technologies.
If you break down what the SEC is asking, right, they're saying that if you are a decarbonization fund or you list climate or ESG in your fund name, you have to back up how you got to that name. That's why they're asking you scope 1, 2, 3. And I think that's a very fair ask, right? If you say that you're focused on decarbonization, you should probably have metrics to support it. Today, there have been funds that have said that they have a climate tilt or that they are climate oriented, but are not providing those metrics to investors. So I think from that perspective, what the SEC has done is very helpful. There is the company aspect of it, which of course you have scope 1, scope 2, scope 3. But if you are a public company and you're listed, most likely you either have already done some amount of carbon footprinting because you want your carbon footprint to be in an MSCI ESG analytics. That is kind of the #1 ESG ratings system that allows you to be a part of an index or not be a part of an index. Or if anything, someone has already looked at your company and has estimated what your carbon footprint is. I agree with my fellow panelists. Software, I think, is what is going to be able to help from a cost perspective, especially for small cap companies. But for those large and mid-sized companies, I would say they're probably already doing it. They're focusing a lot on scope 1 and scope 2. I think scope 3 is very difficult, as we can all probably admit in this room, and it'll take some time. And I think software is definitely a key to understanding that.
Yeah. No, I definitely think the large companies are ahead of the curve, and in some cases have advised other thought leaders in DC on what will likely work, because they have had a footprint and experience and frankly dedicate a significant amount of resources globally in terms of the scope 1 and 2 proposition. So the good news is that this decade we're having this conversation, and there will be change. There is change already. Whether or not it's 2030 or 50, I don't focus on those numbers, and I think that those are challenging numbers depending on where we are. But at least we're getting to the point of addressing carbon emissions.
It brings up, like, when you think about triple bottom line, you can define that differently. Maybe there's, there's like the B Corp versus the nonprofit. Like, there's a lot of ways to do social impact company, right? And they don't all have to be nonprofit, and they don't all have to be, profit only, right?
Yep.
So similarly, like, depending on whatever your implementation of ESG is, it seems like, and I'm saying this because I really don't know, but it just intuitively for me, but it's bias, seems like the innovation aspect of your allocation has to be thought of too. In other words, what percentage of the portfolio is in alternatives if we're going to go down this path? Because a lot of what is going to be created by new metrics, new reporting, new compliance is going to require innovation, which means it's an opportunity to potentially fund those technologies. So does it just mean refocus of whatever percentage is allocated to that kind of venture risk, focused only on things that support that synergistically, or is it an increased percentage point or two into venture as a strategy because it's needed and opportunistic? I'm just curious if you've thought about that at all.
You can go first.
If you look at the ESG investment opportunity today, there's obviously a lot of ESG funds, especially on the alternative investment side that's launched in the last 3 years. The opportunity side is either on the venture, which is like software-led, smaller, climate AI, all the way up to infrastructure. So you have these large, managers that have 3 billion plus funds looking for either one of those spectrums. In the middle, the growth stage, there really isn't that much. I think right now we're kind of at an inflection point where a lot of ESG companies have been started in the last 3 years. We have to see which ones are going to be the winners to actually get to the growth phase. There's been a lot of consolidation, S&P, MSCI buying up a lot of small providers. So ultimately, it's hard to invest in growth in ESG because no company has either made it there, it's sold to a larger conglomerate, or they're just starting up and they kind of have to navigate this very complex world of ESG versus sustainability versus SRI and reporting. Infrastructure, I think, is a little bit easier, right? Because there are ways for you to have metrics that are much more quantitative to provide back to your investors. It's also a greater amount of capital. Your minimum check size is probably 100 million. So if you're putting 100 million, that's way easier to deploy if you've raised a $3 billion fund. And so you definitely have seen, especially in the summer, in any sort of infrastructure deal that came to the market that was targeted on waste or renewable energy was trading at huge premiums. And so I think we'll continue to see that as these funds start to deploy. But especially on the growth stage, if you're a growth investor looking for ESG opportunities, it can be a little difficult.
If you look at, I like looking at the small.
No, go ahead, go finish your thing and then we'll
And
go.
that's my friend too. All right, Rob, you're next. I'm just quickly, and to dovetail my colleague's remarks, I certainly think in terms of opportunity, yes, infrastructure, right, even drilling down sort of in the other areas of climate. I think I'm a huge fan of hydrogen, and I've spent a time at the K2 first K2 summit in Seoul, Korea, where I met many venture firms around the world focused in hydrogen, H2 summit, pardon me, and also ag tech. So there's, I have, in the ESG world, drilling down another layer, there is great innovation. I tend to focus a little bit more on climate, but there's a great innovation across ESG in particular. And yes, infrastructure as a broad base, but depending on your mandate as an investor, drilling down in some of the areas of ag tech, solar tech, climate tech, and hydrogen has been a lot of fun.
Let's go here, and then Chinwe will go to you next.
Hey, thank you. Ron Calderine with AIC Investment Group. Defense came up a couple times yesterday from the institutional investor from Canada, so the growth company you're presenting. Defense goes to protection of not just Ukraine, but Middle East, other interests friendly to the U.S. and within the U.S., through distribution and other things. How does that play out for ESG? Because the Canadian speaker spoke that on one hand it was on, and then it became popular. Is it really bifurcation between systems versus sort of systems and protection versus bullets and missiles? What do you think?
That's an easy one. No.
I think it's increasingly complex, right? There are multiple asset owners that have screens on controversial weapons, cluster munitions. So those are the most obvious, right? Anything that's very prone to destruction. We had a portfolio company that wanted to invest in a consultant to defense. They couldn't assure us whether defense meant, satellites. They couldn't assure us it didn't mean, construction of these type of defense weapons like cluster munitions. And so because of that, we didn't invest in that particular consultant. So I think partly will depend on what your LP stance are. We don't really do much defense. It's hard for me to kind of answer that as an asset owner or as an asset manager. But from an ESG perspective, I'd say defense has been one of the institutional screens that's been around for over 10 years. Where that kind of cuts off, I think depends on LP by LP and what you state in your PPM.
Yeah, go ahead. No, Chris.
I was just going to say, it's also increasingly complex because the nature of war is shifting rapidly to covert in ways that we all know, whether it's AI or what have you. One of the advisory clients that I sit on is the Singularity Net, which is Dr. Ben Gertzel. You probably have seen Sophia the Robot, the first Saudi citizen in AI. There was a joint venture between them and Hanson Robotics several years ago. And that's a platform for essentially benevolent AGI, artificial general intelligence. The statistics, for those who are curious, are there's about 6 companies in the US and 3 in China. They control the majority of R&D related to artificial intelligence. And that is being weaponized for either mass consumerism, because it's 70% of our GDP a year, or warfare, which isn't a shock to anybody. So the existential threat to us is not a country. The existential threat to us is not a Terminator movie. The existential threat is just no choice. The reality that we're compounding, and we hopefully, as Ben would say, hopefully we end up as squirrels in the park, not as house pets, right? Because squirrels in the park are at least still free. They can run around the park and they don't know anything from a house pet, to the AI. So not to go down that thread, but the ESG component of it is if we really wanted to break our brains and just paralyze ourselves, we'd worry about where defense sits in it or where it doesn't. And the reality is it might just be as practical as going, we have a fund that deals with that, and that's not an ESG fund, and then we have an ESG one that doesn't touch that at all. Because anything else is just going to paralyze. That's just my, again, don't sit in the same chair as she does. I just look at it through that lens. And, as humans, I think what showed up in the last panel, there were so many good nuggets, but empathy and these concepts that we throw around, but they're really important, like understanding the trade partners and the fact that governing a growing middle class is usually the hardest thing in the world to do. And you have 2 countries with over 1.4 billion that have growing middle classes, which means they're under extreme pressures and they're going to be under extreme public unrest as they try and continue to do authoritarian type things or even run a democracy. So if we want to create a new world order that works for the broader set of humanity and doesn't end up in nuclear fallout, then empathy is probably a good idea across the board to try and understand the other side of the table and just find a non-mutual self-destruction model forward. So those are my rants on kind of whatever the hell that was. Anyway, anything to add?
Let's take another question.
Chinwe, let's go to you because you had one earlier. Thank you for your patience.
Thanks very much. Very insightful. Enjoying this conversation very much. I just thought, looking at there's quite a lot of widespread opinion that we need to integrate ESG into our investment decision making. But at the same time, the science is showing that the investments needs to be accelerated from now to 2030. We can't wait to 2048. So I was just wondering, as long-term investors looking at this, how are you taking into account whether in your ESG frameworks or your transition plans, the requirement or the need to front-load these investments in the earlier part rather than waiting for
You want to repeat the question?
think- Yeah,
What are the
sure.
frameworks? I think that was the question, right?
It was how are you differentiating?
To accelerate and front-load investments that looks at mitigating climate change.
Okay, short-term and long-term. Okay, yep.
I think those are two separate objectives. The first, as an ESG professional, you're looking at ESG risk and opportunity. So the assets that we're invested in, from a long-term perspective, are they going to cause long-term performance, right? And what's the best way I can underwrite that? Is my base case a 2-degree scenario of climate change, and then is my downside case 4 degrees, which is currently what we're on track with. The other side of my job is to look at opportunities, understanding that we need to reach a decarbonization economy pretty quickly by 2030. I think that's really where the IRA comes in, of being a very nice deal where they've left breadcrumbs of where the value chain is for decarbonization, and they've made it very lucrative for private capital to come in and invest. Having said that, we've done many ESG deals where we're looking at PPAs, or looking at solar installation, where it is becoming more economical. That type of decarbonization energy is more in demand. It's cheaper. OPEC Plus is meeting today to talk about what price oil is going to be if they're going to decrease their supply. In the summer, oil was trading around 120. Today, it's trading around 86. If they decrease the supply, they want to make it up to probably around $100 a barrel. Given the situation in Europe right now, it's going to be a very tumultuous winter of whether they can afford it and where they're going to get that energy. The only issue with decarbonization and these type of, solar, wind, hydrogen, it takes a long time for infrastructure to develop. It takes a while. You can't just kind of turn on the pipe, so to say, and increase your production for the winter. So countries need to start planning this earlier. And I think, if anything, the Russian-Ukraine war is really causing that to happen much quicker.
So you have, and I agree with you that these are two questions, which are two perfect questions to ask when you're speaking about climate. For us, we hired a team internally so that we could track our carbon footprint, we meaning Amalgamated Bank, from the standpoint of, and obviously we set our own goals, and I'll, as you start where you are, and then have an execution plan and define whether it's 2030 or 50 or whatever the institution is. As an investor, you have, both in the public and private markets, that's a framework, and then it's execution, and certainly in the alt space and the direct space, that's where your opportunity is to see where the, to analyze companies and determine who has the best growth metrics, and that's, I spoke about a little bit earlier. I happen to be a big fan of hydrogen, but there's plenty of other opportunities out there from the standpoint of investing directly in companies that have solutions for climate and climate tech.
I like getting invited back, so we got 5 minutes, and we're going to be on time again, and I've got 2 questions I want to get to. So Winston and then Rachel. Oh, 3. Well, maybe we'll get 3 if we talk fast.
Question about the Apple, Amazon, Microsoft, etc. Because they're a big part of the mix. So for most of the SMEs, they have public market products, most likely have, but very rarely people talk about the distribution of those guys. I think the reason is from the east side, they tend to be good, right? Because tend to be reducing carbon emissions. But on the SNG side, these guys are the largest platform holding most of the data of the digital economy globally. So from a data privacy, data security, data value perspective, right? Huge SNG issues. So how do we think about the ESG issues of the largest companies who are the biggest part of the
Oh, man. All right. Can we do another panel after lunch or whatever on this one? Because I spent the last year of my life in privacy and why it matters. Building an operating system for a mobile phone that gave you choice and made you the proxy of your data and whatever. And I spent way too much time worrying about all these things, and I still worry about them. So I think that's a tough question to answer, but I think it's a really important one personally, because the reality is that the only thing that you and I all share with the other 8 billion people on this planet is the fact that in 2018, which is the last data point that I can remember, so it's exponentially higher than this, in every 24-hour day on a 10-minute cycle, we threw off 10 gigabytes of data waste, data exhaust, as humans across the planet. So whatever it is today is exponent, 400 zettabytes, if you want to look up what 400 zettabytes is. 400 trillion gigabytes of data exhaust. That's data we didn't do anything with. Less than 1 to 2% of that was refined into actionable insights by the Amazons and the tech companies of the world. And we had our first $2 trillion market cap companies for a variety of reasons, but certainly that was a contributing factor. So if data is the new uranium, and not the new oil, it's the new uranium, where does ESG fit in that? That's a fundamental, in my
Negative free pass.
Well, no, but
fundamental, that's like fundamentally a question, because democracy, everything relies on potentially that outcome. So anyway, that's...
Well, we spoke a little bit about this last night. And that is a tough question. And so, but in the interest of time, I'm just going to share a snippet of what we spoke a little bit about last night. And there is, looking at the broad universe, as Amalgamated and other investors, it's not just Amalgamated that does this, but we remove companies that don't fit what we view as the definition of ESG for our clients and stakeholders, and we replace those companies with others. And not to go into the details, but obviously that's a tech solution. But all I'm saying is what you're asking is now doable today. Is it going to be matched up returns? No, I mean it's like any index. There's going to be plus or minus, probably plus or minus a percent, or plus or minus 50 basis points. But the reality is the tech is here to achieve what investors want. Whether it's removing large tech companies from the index, can they achieve market returns? Yes, with technology, they can be that can help.
I would say, sorry, I'm just gonna, as an index and fundamental investor, if you take out FANG companies, that's huge tracking error. So look, like Microsoft is actually a AAA rated company by MSCI ESG Research. Again, it depends on what is your definition of ESG. If it's the management of E, S, and G risks, Microsoft does a really good job. If you look at Facebook, Facebook obviously has huge data privacy concerns. It's involved in quite a lot of litigation. For them, they're kind of on the cusp of being a CCC rated company or a really, poorly rated ESG company. But as an equity investor, it's something you're actively preparing for, right? You can't take that type of tracking error risk, especially if you're in an index.
There's two ways of doing it. I just got to interrupt because, and I did it too quickly, I would never say take out 100% of all tech companies. Of course we can't do that. But the reality is we can take out, depending on the definition, some of them and have, not 100% of them. And the flip side of that is owning them and addressing issues through shareholder resolutions, which is another active path that asset owners take, whether it's a pension fund or Amalgamated Bank or any other institutions, but owning the shares of the company and working on and speaking and addressing issues as a shareholder in a shareholder resolution format, and even taking, you just saw Engine 1 with Exxon, and then the slate that they now have on their board. So there's different ways of addressing what your definition of an ESG. And there's no question, if you're investing in an index, whether it's S&P 500, there are paths to replace companies that you remove, and there's also paths to advance your values through a shareholder resolution mandate. And that we don't have enough time to go into more definitions, but I had to jump in here because clearly I wasn't talking about 100%, which I know you know, but clearly we have an opportunity to do both.
Rachel?
This is likely a quicker answer. So non-investment or divestment doesn't give you a seat at the table, and given the amounts that you're investing, particularly in the private markets, you could, I'm assuming, have quite an influential seat at the table. So my question is, would you invest in a oil company or some company and improve the metrics, or if it doesn't pass the screen, it doesn't pass the screen. Because you could argue that improving a company, you know, taking a good company and making it great has excellent ESG benefits.
So, pardon me, see the question, I didn't hear the whole question.
Can I interpret it this way and see if what I think she's asking is, do you stay away from like an oil company or a problematic ESG reporting company, or do you invest in it and make it better? And in other words, if it's a good company with good fundamentals, but it's lacking the metrics that would make it an A-rated or AAA, do you invest in it and then basically take the risk that you can't get it there, but if you do, there's going to be a bigger ROI, or do you pass on it because it doesn't pass the initial screen? I think that's what you were asking.
I mean, and the reality is, I won't take it company by company, but the reality is when you know, as a portfolio manager, you're going to look at your slate, you're going to look at your mandate as your investment policy and understand what you can and can't invest in from the people whose money you're investing, and whether that is removing a company or not investing in and replacing it with like companies to replicate or match what you're missing, or whether it's a path of shareholder resolution. I mean, that is a huge path, and there's plenty of third-party institutions, if as many individuals can't necessarily do that with their holdings. There's plenty of funds that do that, and you know, obviously great changes have been made on that path in terms of owning a share of a company and speaking up and advancing and ultimately making the company better. Because in the end, that's what we're all trying to achieve, is make the businesses better. I just picked on Engine 1 because that's the most public, but there's plenty of others. I mean, that's obviously the other side of the spectrum in terms of an activist. But shareholder resolutions have been quietly advancing huge changes in companies, large pension funds. I mean, that I've sat on several committees. That's fantastic 30-year veterans. That's what we analyze and do, and vote proxies and work with companies directly to help make them better. And that's the tech companies of the world, the Microsofts, to middle market companies.
We have one more question back there. I forget.
Should I hit on the private side
Yes,
really quick? Because
yes,
I
hit
think
on
your question was on private markets as well. I would say that, you know, we own a fair number of data centers and we sit on the board for those data centers. You would think data centers, of course, high energy emitting, you know, assets, probably not the best from, you know, any sort of renewable energy, but generally what we've tried to make the board do is think more about energy efficiency. Even if you think about cooling systems, a lot of cooling systems for data centers today are actually done through fresh water, which is obviously a very finite resource. So thinking through technology of actually taking, you know, salty water and converting that, and thinking through, is there a way for cooling to be more efficient without as resource depleting is definitely an area of growth within the private markets.
Great.
Yeah, I mean, following that, some of the best SaaS opportunities we have, as you mentioned, are the companies that actually provide the benchmarking information that incentivize good behavior.
Mm-hmm.
So to the point where you're requiring disclosure from these companies, they need the SaaS platforms, and the SaaS platforms provide the economic incentive for these companies to actually comply. So it's either the cost of regulation goes down for them, or the cost of compliance becoming an economic opportunity. We have one cellular company that literally is building towers as a giveaway because of the carbon credits. Carbon credits is such a revenue opportunity for them. They do the cellular towers as loss leader. So it drives behavior. Related though to those categories, one question I would ask is, following on Winston's point about ESG being sort of segmented, have you seen yet any initiatives on the social side when it comes to the impact companies are having within social media, within the communication? I was just at a summit where a bunch of companies are getting together next week to simply try and hold large media companies or companies that have outreach to consumers accountable for the impact they're having on their consumers. Whether it's, let's say, psychological behavior, whether it's misinformation, whatever it might be, but it seems to be a rising standard. I'm wondering if that's showing up in any of your metrics.
So, go ahead.
No, I think that's a public market question.
Well, is it? I mean, you're speaking about large companies, but there's also plenty of small ones. But in terms of, but no, I know from the standpoint I haven't seen, it's certainly part of conversation, you know, in terms of analysis, certainly part of conversation in terms of metrics and researching companies, both public and private, you know, given the media sector, industry as a whole, but in terms of action, which is, I think, the ultimate part of your question. It's part of the research. It's part of the research, and that goes. And I always get down to basics. The framework of the S. That is part of the framework, and looking at a private company or looking at a public company is that's a judgment company by company.
The reason I would actually say this, why I think it's a public market question is because the public markets are getting the most heat on it, right? So Facebook, for example, has so much heat over whether teens who are on the Instagram platform or the Facebook platform have more depression because they are on those platforms and what they're seeing on it, and whether the algorithms are targeting these particular teens, you know, in a way that's very destructive. And so generally, I think I've seen more conversation in the public markets to hold FANG companies accountable for that type of behavior. And I think that's going to trickle down to mid-cap, small-cap companies that are, you know, slowly entering into the social media, public market, public appearing interface. And of course, that will come down then to the private markets.
So what happens in the venture world where some of the innovation takes place, and some of them are swept into the venture arms of the large media companies, that's the conversation publicly is driven by, you know, the Fortune 1000, but in the venture space, if you have tech and media tech and you're hoping to sell your company to any one of these large institutions, that's definitely part of the conversation. And certainly as a venture investor, that's certainly part of the research element and looking at the company and seeing how they're addressing what is very publicly being discussed and addressed by the larger companies.
My final 2 cents, and then we'll go to the next panel, is I think it's a great question. I think that movement is an opportunity because it could be that it's a natural, non-politicized bridge to ESG adoption across different political beliefs, for lack of a better word, because The Social Dilemma, if you've ever seen that movie, if you haven't, watch it. If you have kids under 15, you need to watch it. These things have started, years ago, but they really are starting to get to a groundswell of awareness. And having spent the last year really immersed in kind of that market, one thing that I never got told no on was that you could protect me from my technology, because you can't stop me from using it. I'm addicted to it. I know that, but I wish I felt safer. I wish I didn't feel like it went from not worrying about being listened to because I got nothing to say to like, wait, it's kind of creepy. I don't want an ad served about a vacation I was talking about in my living room with my husband. I didn't know anybody was listening. I don't want that on my Facebook the next day. Like, that awareness is there, and I think framing it through social as part of that ESG could be a bridge when you can't get them to see carbonization or whatever as a bridge. So it's just a thought. Thank you guys for amazing panel. Thank you. Lessons learned and advice for the future. Take us home. Jaha Cummings and Sasha, is it Bernier? I believe, or Bernier?
Although I saw Jaha just run out of the room. He's scared.
He's coming back in like with a curtain or something.
You guys are awesome. I learned so much. Thank you.
Really great. Thank you.
Oh, yes. And just a quick reminder, if the panelists could go outside and get a group picture before they leave. Actually, a can of diet. I grew up in a can of Diet Coke. So I know the can of Diet Coke. Micronesian. Is it a can of Diet Coke? Yeah. Do you want to drink?
No, I'm good. Actually, can I have Diet Coke also? Yeah. It is like my one. I do drink like one Diet Coke.
Anyway, I'd love to talk to you. I want to
I
your current job too.
Yeah, because I might sit myself. Come and sit.
Good to see you too.
Okay, everyone, we are down to the last panel of this excellent event tonight. I'm super excited because I have two stellar panelists who are going to be looking at lessons learned and advice for the future. And it's extremely topical given that some of the things that we've been discussing have been climate risk and also cryptocurrency. And my fellow panelists are extremely experienced in both these areas. So I'll just do names and title and then have the panelists introduce themselves. But Jaha Cummings has a number of hats. Predominantly, he's also treasurer of Southwest Florida Regional Planning Council. Obviously, very topical. We'll be talking a lot about some of the climate risks and issues and litigations that he's faced recently. And Sasha Bernier, Managing Director of Cheltenham Enterprises. So maybe Jaha, we'll start with you. If you could tell the audience about the 4,000 hats that you wear.
I say I'm a very Florida-involved person. I might say 8 generations of Florida, my family. But I'm on the City Council in Punta Gorda. I'm also treasurer of the Southwest Florida Regional Planning Council, which we basically do planning for the 6 counties from Sarasota County down to Collier County. And so, especially economic sustainability is a big deal. Also disaster preparedness, so those are 2. Also, I'm on the Florida Freight Advisory Committee, so we advise the state on all air, ship, rail, and truck trade issues. And so this all kind of plays together. And then also I manage a commercial real estate company in Punta Gorda also. And in regard to this, we, in Florida, I guess since we're in this kind of states' rights time in the United States, Florida has taken on, I guess, acting like, almost like a little country in a sense that it's trying to solve some of its own problems, especially when you get to, like we had a meeting about 2 months ago on the supply chain issue, rather than being susceptible to. So Florida has been, let's say, a net consumer of products. Now Florida's making a decision to actually be a net exporter. And so this is something which came out of the fact that after last fall, especially with Long Beach having its issues at the port, it severely impacted Savannah, which is Ports Authority of Georgia are actually our main competitors for ports in Florida. And so looking at the problems they had, we knew it was going to happen to us. And so we've actually really pushed forward with creating an inland port infrastructure as actually having a way where we're actually going to integrate truck and rail as a way to get away from the vulnerability of these seaside ports, and also just become more efficient. Plus, with the generational change, the real truth of the supply chain issue a lot for the United States was the fact that we don't have as many truck drivers, and the younger generation don't want to be truck drivers. And so in order to kind of get ahead of this and not have that be like the pinch point that Herm says, we're really trying to wake rail up. And rail is something which should have been countrywide from the early 1900s United States, but there actually was a concerted effort between the auto industry and municipalities to pretty much get rid of anything that was mass transit, in lieu of creating suburbs, which were these amenity-less areas that required you to have a car. And so now the consequences of these planning decisions have now come to a head that we've got to have much more just integrated process. In my former life, I lived in Japan, between Japan and Micronesia, and I saw very clearly how well, when you have a very strong transportation system, how well that's a really strong infrastructure underpinning a strong economy. And so this part of my role is to bring these lessons to the state of Florida.
Excellent. And we'll dive down into more of them about being the net exporter and how you can, the railroads and the physical infrastructure. Sasha, a bit about your background.
So I'm technically considered a Florida resident now, but mostly in New York. But that being said, I spent about a little bit more than 10 years running a family office. Now I'm more on the investment committee, I spun off about almost 2 years ago, which is crazy, to found a firm called Hestia Holdings. We were given capital by a family to run a diversified book opportunistically, however we want. So it's been interesting navigating the market. And as I said, it's really more it is a high alpha strategy that we run. And we call it the 4 quadrants, where we invest opportunistically across different classes, and then we'll put funds into trusts from different family members into funds that we think are uncorrelated to the market, sort of like art investing, for instance. So that's the strategy.
Great. And so the title of this was Lessons Learned and Advice for the Future. So maybe we'll start with some of the lessons learned. And I'd love to start with you, Jeff, with your position on the Florida Planning Council. Very timely with Hurricane Ian. How were you prepared for this, and what were some of the key lessons from?
Well, one thing I guess we do when it comes to, especially our pensions, especially the one for our city, we actually do right now about 15% of our investment in real estate and infrastructure. And we found that if the pension goals are 7%, we managed to keep around 15%. And then even with this not so good bond market, we've still been able to keep around 7%. But we've done this since about 2010, when things got very soft, and when the Fed, when you were allowed to have more of a bond substitute scenario, we use of that. And so sometimes we use infrastructure because you can actually make an argument that some of these infrastructure investments are fixed income, that we've kind of been able to use that in that manner. And so we've been able to have a very, very strong performance of our pensions based on that. Also, it hedges against having everything, I say, in our local pot. We try to make investments in other areas, and so some of it also is environmental. Then the other aspect, when it comes to Regional Planning Council, one of the big issues, we work closely with the Economic Development Administration, Department of Commerce. And so if there are infrastructure things that we need to invest in terms of either disaster resiliency or economic resiliency, the federal government provides 80% grants to that. So if we have some projects, disasters actually provided a very good opportunity for us to actually get funding. For example, the airport of Punta Gorda, we were actually able to use those funds in order to, the disaster, say, Irma, which was maybe 4 years ago, we used that time. And so during this time, on one hand, there's a lot of destruction. The other hand, these disasters also do provide some that when we were talking about real estate markets, we were getting very, 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 very hot. And we were having a severe shortage of affordable workforce housing. And because a lot of our market was being bought by outside firms, to the point where half of this new stock was housed by people, there's going to be a flight of people who are leaving our area because they're frightened by the storms, which just means there's going to be no people buying it, and probably we're going to be able to address our workforce housing issues probably because of this storm, where without the storm we wouldn't. So it's kind of weird. And so what I'd say, disasters, they're horrible, but we also try to see the good in them also. So that's just kind of the life of living in a place like Florida. You have to kind of go with the punches.
Yeah, lessons learned in every situation. And you mentioned the reset. Maybe from your side, Sasha, can you talk about, in terms of like diversification or lack of diversification, what might have led to a reset in terms of your portfolio?
Right. I think right now, as we navigate these choppy waters, what I've learned, and I look back, just my experience, it's really important to separate following the herd from whatever you have conviction in. And so I'll start off with, I guess, how I've evolved. When I was heading to college, I had a internship, which is a stockbroker at Morgan Stanley. And at that time, very new to the market. And one of the biggest mistakes that I made was I took some scholarship money that I had going to the University of North Carolina, and this was in 2000. And the broker was like, "Hey, put money into tech because the market just keeps going up, right?" And unfortunately, it was literally I think like 6 months later, that money disappeared, and I had to go to my parents and say, "Hey, Dad, I lost this money. Can you help me?" She was like, "What the heck happened?" Right? And if you remember that environment, everyone was just was going into tech. Everyone was following it. And from that, I learned that the lesson was really to be able to separate what everyone's doing and build conviction. And then when I started my career in Wall Street, after doing banking, I went to work at a credit desk, and kind of the same lesson, right? Everyone was going into credit. Everyone liked real estate, and I remember our firm, which actually ended up going down, also because of Lehman, was if you like something. I remember a quote that my colleague said: "If you like something at 8 times, you like it at 6 times, you like it at 4 times, you like it at 2 times, and before you know it, it's a 0, right?" And from that, I learned really, again, think about confirmation bias, meaning that sometimes we get clouded. We like something, and we're not able to take facts that remove you from confirming why you like it, and you continue to put into something even though it might not be the right investment. And then from there, as we cycled that out of that experience, and really went on an unprecedented bull market because of where rates were. I think it's important now to, what I've learned from that is understand, what it is you believe in, understand what the herd is believing in, and really try to have core principles of where you like to invest and build around that. And so, as I started building our book, the way I thought about it was, so one of the key things that I've learned, sort of like what Jaha was mentioning, was, okay, my core belief is, all right, what will I base my invested thesis around? And when I did my research, I do believe that real estate is just a core, will always be a good core investment, right? Regardless of what happens through time, and especially through multifamily. If you look at both the cycles I've been through, whether it's 2000, 2008, and we'll see how it develops now, real estate has always maintained the test of time. People will always need a place to live. As long as you make sure you understand your costs, your expenses, what the ratio, coverage ratio, which is primarily interest, it will survive, right? Especially if you invest in good areas. So when investing in our core book, we always keep a good amount of real estate. And I especially thankful because right now, if I didn't have that core, we probably would be, not probably, I know my backer would not be happy because we took a lot of bets in crypto, right? And crypto was a relatively, it's still relatively new. It's very high beta, very hard to understand. Even though I have long-term conviction in that, the real estate aspect of it has allowed us to relatively be slightly down to flat. And again, it's because we have a core belief. And even though that part of the market, not just crypto, but high growth stocks in VC, all that was really just driven up because of where rates had gone, where there was really no sense of what valuation should look like, what it should be. But at least knowing that we had real estate, that it will always grow into it, especially if you're growing markets, it was really our safety net. So I think, again, like, have a core and understand how you're going to invest around it is some key principles that I've learned and I try to stick to.
I really want to back up on some of those behavioural finance aspects later on, because I think it was Christian mentioned yesterday that for them the biggest challenge was indeed behavioural, and I know we spoke about the structuring of the boards. But before we go there, maybe, Joe, I'd love to see how you view real estate in the portfolio and diversification, please.
One, I would say, a best practice in real estate is understanding that you have to have local knowledge. Something that's fared well for us is that in areas that we've invested in, we've actually dealt with local firms who are local to that city or that state, specifically because we want to know what the zoning and legalities are. In my role in terms of being a local elected official, what I've seen is that pretty much 90% of business is controlled by local government. You're talking about your zoning, your local tax regimes, things like that. And so it's one of the things where if you don't have an understanding of that, you may miss the ball. I'll give you a good example. Right now in Miami, you see a port which is very, very full. The real plan for that is that they don't want to use their real estate for the purpose of freight anymore. What they want to do is actually, they're looking at having doubling their passengers within the next 10 years. So, and this is part of what the committee we're on, we've actually convinced them to be able to basically create a rail pathway to move those containers to Clewiston, where there's actually an airport. We're creating a new freight-only airport, the Everglades Airport, which is going to be importing all the produce and flowers from South America, which currently come to Miami. And I say this as an example, and this now we also hook into the fact that we're creating an inland port 9 miles from there. Not knowing that fact, you may do some investments in Miami that relates to that where it's really not going to be on that. So I just say in general best practice, very important to understand the role of local government and also having local market intelligence. Also to the point, if you're dealing with local partners, the underwriting for their financing probably is best going to come from, I would say, regional banks, because they're going to actually understand what's actually happening. So I just say that in terms of your business intelligence, it's going to require, I guess, not resting on your laurels and only using those data sets that are readily available. You're probably going to have some people on the ground if you want to do that. And with that said, we also invest in things like Amazon warehouses and cell sites and just things like that, which I say that are almost like a triple net person, that you know this is literally infrastructure. Also things like toll roads and the fact that our interstate gas tax has not been reinvested in bridges and highways, and so we see that as a growth point, as well as kind of rebuilding the country just in infrastructure.
No, that's really a really good point. We had invested with a group, thank God it was a loan, from Arizona that invested in Mobile Park homes in the Midwest. They had done a good job in one area, in one location, and so we decided to support them in the Midwest. But when they decided to go that area, they didn't really understand the market dynamics. So for instance, basically the homes, you could basically buy homes almost for the same price at the Mobile Park, and the third-party group that we hired completely missed that. And literally NOI went from like $1 million to zero. And I was like, bro, you have to be completely incompetent for that to have happened. And we were able to replace them and thank God save the investment. And so I think what Jaha is saying is really, really important that when we, from now on, that they know an area, they own units in the area, they own the in and outs. And I think this period is going to be really, really interesting also, because another thing that's really be important though is really understanding experience and how far back that experience goes. Because for a long if someone's under 30 right now, I'm probably going to be less willing to invest with that person, because they've never seen. I graduated around between 03, 06. They've never seen treasuries where they are now, right? So they don't understand that now you have to, whether you're picking stocks or whether you're picking a company, whether you're picking real estate, what this type of market looks like, because between 2010 to now, everything just went up, right? So how can you pick someone to be a long-short equity hedge fund manager if they've never seen that before? They've never had that experience, or a macro fund, right? Or someone in real estate, right? That has bought something at a 4 cap rate, exiting at a 3.5 cap rate, right? Because they just think that the Fed's going to keep keeping rates low or going down, right? So you really have to discern now really what that experience looks like, because it's a completely different market. So when I see someone's model that I'll give you another example. We're seeing 6 months ago, right? You could get a Fannie Freddie loan on real estate at about 3%. It's now approaching 6%, right? And if someone's still showing that they're exiting at 4% cap rate, that's insanity, because not only is your leverage higher than your cap rate, you can literally look at the Treasury forward curve and that it's gone up. And so we were at this conference a couple days ago, and I had met this family that they've been in real estate for 2 years. It was a husband, a wife, and their child that just wanted to go into real estate. They buy in Texas. And I asked them, so how are you thinking about this, right? And literally, they didn't even mention the idea of discount rate going up and, you know, discounting the cash flow. Like, they were still thinking the same way. And so again, it just hits home that you not only do you want that local experience, but hopefully they've gone through a cycle and they understand that, you know, the market has changed.
Interesting, because you also mentioned that you've been heavily investing in crypto, which most people are under 30. They've only ever seen the market go up. It's one of the ultimate kind of herd mentalities at some point. But I guess you're investing in a lot of the infrastructure as well, aren't you? Not just the coins.
Yeah, I mean, so this is going to be I think a very interesting time for crypto, because I do think that there was just a ton of froth, a lot of money just washing around, and a lot of the, I guess what you call the crypto bros, same thing. They haven't gone through the experience, didn't really understand the certain protocols. I mean, for instance, right, if you were in Terra, you could literally watch, it was like watching a slow motion, a car like crashing, right? You could see the chain, what was going on, right? But it was weird, but no one, you know, everyone just thought everything was going to be okay, right? But I think the lessons learned from there was that it wasn't difficult. People will say it's hindsight's 2020, but like, if it sounds like a Ponzi scheme, it's a Ponzi scheme, right? I mean, so it was hard. Like, no one could ever explain, you know, how you were getting 500% returns, right? But again, it was just, you know, everything was just being inflated, so no one thought about it and cared, right? But at the end of the day, though, other things. I was talking to a lawyer that gave a really good perspective. The things, though, that are good about crypto, you don't hear about it, right? So there were things like Uniswap, right, operated the way it was supposed to operate, right? Bitcoin, for instance, even though it's down significantly, it's operating the way it's supposed to operate, right? There is no invisible hand, you know, going in to save it and printing, right? Because at the end of the day, we could all argue that the U.S. monetary system has also become a Ponzi scheme, right? And so who knows how long this is going to last. I think yesterday there was an article in the Journal that talked about, you know, we're at $31 trillion of you know, deficit, and Biden was like, oh my God, I can't believe, you know, we're at 31 trillion. Dude, you passed like $5 trillion in your 2 years, 26 plus 5, right? What else do you think was going to happen, right? And so, you know, so this is a very kind of weird market, right? Because we have treasuries at 4%. Every time now that we issue debt, and the debt's just growing significantly, you know, it's another $300 billion of interest expense, right? So all this, how are we going to pay for all this stuff, right? And the government now, because of inflation, can't inflate its way out of it, right? And the only reason why the U.S. is able, we were talking about, someone was talking about the U.S. being its position, the only reason why we were able to maintain this crazy deficit for a while was because, you know, we were just kept printing money, but now it can't because inflation is the way it is right now, right? Which leads me to believe, and we were able to export it to the rest of the world, but just because, you know, don't want to go back to geopolitical, but I think China had this window, but she overplayed his hand, because I do think that if she was a little bit more driven by capitalist principles, people would have went to the Chinese yuan, and he kind of messed up, I think, a little bit, because they don't have some of the systemic issues that we have, and then Europe just seems to perpetually have issues, and so the U.S. we're forced to, you know, to think about the U.S., but the U.S. has severe issues, which is really why we saw the crypto movement, because the younger generations are like, why are you messing us? Your generation's messing us up and forcing us to, you know, use the U.S. dollar, right? And so if you look at crypto, Bitcoin is structurally doing what it's supposed to do, right? So I think you have to separate the noise in crypto from the stuff that's actually working. And so I think this is going to be interesting next 10 years in terms of investing.
You're making me think of something. I guess going into other best practices in real estate, I think it's also important to actually have someone in your group specialize in that and learn the model. I say this because this may sound counterintuitive, but they make more money than me because the aspect of hospitality is that hotels are very much cheaper pricing many times. And so because they do that aspect of hospitality, when all of a sudden everyone wanted to get out or everyone wanted to come to Florida to escape the lockdowns, they were able to literally change rooms that maybe were $200 to $600 a night like this. And so, and because their management is active literally every hour for our prices, their portfolio will well in times for people because of that knowledge. And the same we have something called Babcock Ranch, which is Shelby County. Storm messes everything up, but Babcock Ranch is the world's first 100% solar city. That's 100% in that they have 150 megawatts of solar panels, but there is gas to back things up just to make sure we're good, because we don't have the battery technology yet, but we'll leave that as the quiet. But Babcock Ranch, they have given local knowledge. They've built a smart city, totally wired for everything to be that place, to be like example for infrastructure, for a crypto example, to do that. But another part is when they're building, there was a certain slowdown when they were selling. They had a certain market in mind, a snowbird market, like the older retiree coming down. Rather than just continuing down that path to nowhere, they looked at the wider market and realized that Lee County, where all this happened, the young professionals, millennials, in which we only bid 25% of the housing for because we didn't like their personalities. This is a real thing in real estate. We didn't like the personality of this demographic, so therefore we just didn't plan for them, but they're there. And so, because no one planned for young professionals, two of the builders within this group changed their models. Rather than these large single-family detached homes, the duplexes, condos, villas, immediately changed in their fold. They can't build them fast enough because they have that local, on-the-ground knowledge of what the market is. So I just say that's one key component with dealing with real estate as your asset class. That requires local market intelligence, I think, for you to really win.
I want to ask, I know that they're setting up for lunch, but I do just want to ask one question on advice for the future and tying that back to the behavioural biases. You know, the herd mentality, having the, conviction bias. What would be your advice to mitigate these biases in the future, whether that's structuring teams or just being simply aware of them, because we all have biases. And then I will open it up to the floor for questions.
Okay. Well, all right. Well, I'm going to go to a place which is here, but kind of a diversion. Right now, we're creating this Black Wall Street National Trail. And what that is, this is based on the history of Tulsa, Oklahoma. There was this major economic zone, which was probably the first big domestic terrorism victim. Like, it was bombed, but it had this model for being this dynamic business location. So the city where I live has unique sociology, as despite Florida being one of the strongest Jim Crow states, it was a city that was actually formed, African American, European American, from the beginning, incorporated together. The wealthiest person in town was African American guy till the 40s. We never had segregated like neighborhoods or businesses. And so we had this model which during the times of craziness, we thrived. And then ironically, it wasn't until the 60s that things actually got crazy, and actually urban renewal was the end of this district. So I say this because we're now creating a national trail. I say this because in my role of understanding what you need to be able to get some of these longer visions across, local elected officials you need to give them the political capital to be able to act on your behalf, to advocate on some of these longer goals. And you look at real estate, you need really looking at 20, 50 years. So in this case, what we're doing with this trail, rather than being a history trail, it's an economic and culture trail. And so what we're doing is, we're saying if this city is on this trail, we now give their local elected officials the political coverage to say, we're part of this, you can focus energy and investment on this area. And so I guess where I'm really going with this on a macro level is that sometimes you're going to have to acknowledge that people who make decisions need political capital to do so. And so you need to have the time to fill up for it. Oftentimes it's so reactionary. The news has them going here and there, and so if you depend on, I guess, popularity, your deals probably go down in flames. But if you need to attach it to a longer vision or some kind, and that way you give those people who need to make the decisions on your behalf the coverage to do so. So that's important.
Yeah, I mean, I think this environment is unlike anything that I've seen, and it's better just to be really, really cautious. And I think there's been so much asset inflation that just right now it's just a time to say, you know what, I don't have to hit home runs. And as Jaha was talking, it reminded me of a situation where I'll give you an example. So a good friend of mine works remotely, works at Credit Suisse, go figure, and lives in Florida, and somehow was able to receive government money at like 1% because of COVID relief, bought some property in Florida and kicked out the residents who were probably lower middle class, got new tenants and increased that money, right? So think about that. The goal of the COVID relief was to help people, right? Especially people that don't have, income. And he was able to use government money to kick people out that needed money, right? And, asset prices increased in that area across the board, right? Using government money, right? That's just crazy, right? And so if you think about like all that money that was like sloshing around, right? No one really knows what these assets are really, really worth, because we just, you had whether money flooding from the government, cheap debt that banks had to put in their assets. No one knows. Like everything right now is perverse, right? And so the way we've been thinking about it is, if we can structure our stuff with people that are coming to us because the market has remarkably changed. People are buying assets and they need capital to help them bridge the gap. We would rather just play in the middle. So whether you're doing private credit, preferred equity. So we've been doing a lot of preferred equity in multifamily, because Fannie and Freddie is still relatively cheap, where people need to bridge the gap. And we say, look, we just want a certain return, and we'll wait to see what the market looks like in the other side, because we just don't know what valuations look like, right? So there's no need to really try to get a home run right now, because it's a market that we haven't really seen anything like this, number one. And now all the policies that the government has implemented for the past 15 years, I think we're going to start seeing what the consequences look like, right? So there's no need to be a hero, right? And then be patient, and then work with people that you trust, that that you have good principle, have good character, because I think that's really important, because throughout this past 15 years, everyone's made money, so everyone's happy, right? It's when you're depressed, sad, or you're losing money that you really know the people's character. So I think that's the key for me.
Do we have
So I have seen, there are technology in real estate that's making it more efficient, for instance, right? So if think about the Airbnb model, you can let people check in without physically having people go in. On construction businesses, you have AR, VR technology that allows you to build more efficiently and be less pollutive. Yeah, I mean, I think there are a lot of technologies out there that's going to make it a lot more efficient, allows you to track your, and I think especially on the construction side, if you're thinking about climate change, if you can build a building more efficiently, quickly, the technology is here and it's coming. So I think that, especially in Europe, they're adopting those technologies a lot quicker. So I think that the future is bright and will allow smaller owners to actually hopefully also become active in the real estate space.
I think it's a very good question, and especially because, again, it goes back to a point which we don't discuss is the role of local government. The greatest obstacle to our housing problem is local government, and the greatest savior, because local government is the one who decides zoning. And so if local government decides they're not going to approve those building plans, no matter how sustainable they are, they will not get approved. Or if local government does not decide that there's zoning that will allow it to exist, it will not happen. And so this is why you have to create the political field that it's going to be a good decision for local government to say yes to things. And so that's something that I think we're just at that point now where it's very, very important to understand the role that local government plays in these bigger pictures, because one thing we look at a lot of national issues, we go to Congress, but truthfully they're probably city or county. And so there may be some preemption you want to do nationally, but at the end of the day, it's going to take that work, and that's why some of these, like, say, bigger political movements, the Koch brothers, why they work so hard at local level, because they understand that the decision-making is there. So I'd say when it comes to housing, it really is going to be local to local to local to local. It's maybe as unglamorous as that sounds, we can't do sustainable housing unless we get local government buy-in. It's dead on arrival otherwise.
That's a really good point. I remember a few years back, we looked at a project. The general partner came to us. They were from Berkeley, and I remember I saw a line item of soft costs. They were trying to work with affordability, and it was like something like $350,000 just for soft costs. And I was like, I think this is a mistake, right? I was like, how is it $350,000 per door, right? And they're like, oh no, because we have all these permits and all these things that we have to get through the city of Berkeley. It's $30,000-$50,000. So I was like, who the heck is going to be able to afford this then, right? Like, if it's just your soft costs of $30,000-$50,000, right? And so I think a lot of the issues in San Francisco is because there's a lot of regulation that, like, prevents efficient building. And St. Paul, Minnesota, I think they repealed the law that they were only going to allow you, like, even if you build a certain amount of rent, you could only increase the rent by 3%, right? I mean, that's way less than inflation. In Newark, New Jersey, you can't even increase, I don't even know how that's constitutional. Like, you can't even increase rents right now. I mean, this is from a personal side. I was talking to an attorney. I was like, look, we have to file something because you can't increase. So I was like, we're the only ones that can have to eat the inflation. You literally cannot increase rents unless you live in that building, right? I was like, this doesn't make any sense, right? So they make up these laws that I think they don't understand is self-destructive. So he's correct about that.
All right, so you're going to a very, very important place, I think, that Constitution affords. We start first off, let's talk about, like, pension boards. Very important to have people who, if they're not experts in their field, but their egos don't get in the way of them asking questions to the point where they'll have things explained to them where they know. When you get to elected officials, there is no requirement that you have any competency of any kind whatsoever. You simply be alive is good enough. You know, it's quite frightening. I mean, like myself in that role, I took it upon myself to do the training. Like in Florida, we have a very good Florida League of Cities. We're the first League of Cities, and so if you take it upon yourself, there's no requirement to learn how to do all this municipal zoning, all that. If you don't, and these bodies are made up of people who wish to be there, and there's nothing to require you to have any kind of understanding, anything you're voting on. And from the first day you're elected, you're voting, which is wild. and the same thing, so on that level, I take it to these pension boards, the same thing. it can't simply be something that's good for your resume or good for your social status. It's got to be someone who's really dedicated to their fiduciary responsibility. And I think that the ESG side, the G, is so important. I think we neglect the G. We get, the glamour is going to be in the social and the environmental. But the G is having people that are dedicated to this vision of really hitting this goal of what kind of society do we want to live in, which is going to really be based on responsible governance. And so I think it's a very key important part, both. And also when it comes to who we vote for, it's very important to vote for people who actually, if they don't have so much brain, that they have at least wish to have one.
Yes, and be humble enough
Yeah,
to admit
yes.
they don't know everything.
Yeah.
Yes.
Florida got a lot of movement from COVID and then also the investment incentives from California, from other places. How does that, at the local level, how does that survive, even if it's a change of the state administration and the like? What are your thoughts there as far as the survival of that on a long-term basis for important decision making?
Well, I mean, as of now, Florida, from a standpoint of state legislature, leadership is pretty solid. I don't see a sea change for quite some time. 2010, the legislature flipped to what it is now. And so I would say it's a pretty stable political environment for a while. Florida's already used to over 1,000 people a day moving there. The difference now is you have people that are actually coming, I say bringing jobs rather than coming looking for jobs. So an issue we've had is that in the past, the expressways are in Florida, people would come with the hope, and Florida's really not the place to come if you don't have a game plan. But now we're actually having companies like Goldman Sachs is doing our asset management in Florida. So to some degree, I would say the moment right now is actually helping sustain this moment. And with, again, going back to the hurricane, the danger we had was we had Florida being very, very attractive and people buying Florida to the point of buying Florida and not necessarily integrating it with the local economy. And I see after this disaster, just out of necessity, there's going to be an integration which wasn't happening organically. I think it will happen. So I personally am bullish on Florida even after this storm, because I see that there's some sort of balance that may come with all of this largesse coming. The storm may balance it out for people who really want to be there and invest in Florida.
Understanding Sasha's comment about it's a time to be conservative, to be patient, etc. I could just ask you to turn that around 180 degrees. It's also a very interesting time to deploy capital with resets going on in essentially all markets. For example, life science, biotech, a bunch of companies trading in cash value, etc. So if you had an opportunity to deploy, where are the areas that you might find the most interesting opportunities?
So we've been, I was explaining before, and if you get, I can get a bit more technical on it if you guys want me to, but so interesting enough, when I left Cheltenham on a permanent basis, my principal had made money, he made money in a couple of ways. He had made money in real estate. He was a debt guy, was one of the founders of JANA, and his family made money in real estate. They're one of the developers, one of the 5 families developed in New York. So he's a trifecta for him, right? But but his whole thing was, really preserving capital. And so we did a lot of preferred equity. And I decided to leave because when I had left, because preferred equity had become a 4-letter word, right? Like there was so much leverage in the system that no one wanted it. But when we did it during the crisis, we were compounding at between 15 to 17%. And our last dollar out was 75%, right? And so what happened was that because rates had gone so low, banks have a certain ratio, right? An NOI has to cover a certain amount of interest, and they were able to get that by going up to as high as 85%, right? And so what happened was when rates started going, because rates started going so high, you didn't need that anymore, right? And the jump that we've seen, this acceleration that we've seen, I've never seen it happen that fast, right? So all these people that are buying real estate, right, now don't have enough equity. And so we're back to really what I saw 10 years ago when you needed that capital when rates weren't that low. And so we've structured I'm structuring like these A, B preferred equity pieces where my last dollar out is, no more than 80%. Every time I see the rate goes up, I bring it down a little bit. And, we're compounding it at 13 to 17. And I would never do that with a CMBS loan because they, as soon as you default, if something were to happen, they would foreclose. But Fannie and Freddie, from my experience, they don't really do that, right? So I would recommend that, if you have the experience, you do it directly. And if not, look for funds that do preferred equity. And if you're, and all these VC funds are doing it too now, right? So I'm forgetting the name of Kochu, which is a huge VC fund, is raising money to do that, what they call venture debt, right? So they're saying we're going to lend a really, really low LTV, and their target is they're doing the same structure, but they're getting warrants, right? So if you are like, let's just say you got a $10 billion valuation last year, the market's significant. We can use Klarna as an example. They had gone as high as 45 billion. Their raise, when they did their raise, because they were, if SoftBank ever goes into anything, it's a kiss of death, right? So just make sure you know that. As soon as SoftBank went into it, 4 or 5 months later, the valuation went down to 6 billion. And there are those who are lending against their secondary shares at 30%, right? And then they're getting warrants of that. So they're really interesting. So I think right now is really interesting because money has really disappeared. So if you can get into structuring debt, and you can get 15 to 25%, that's more on the VC side. I think that's a really, really great area. And then there's a woman that we are a backer of her and her funds and vehicles. I learned a lot from her in the art world. I didn't realize how liquid art was, right? And it's almost like real estate almost, right? And if you look at, there's a reason why Stephen Cohen has a $25 billion, art portfolio, right? There's nothing that guy does without thinking about, how much money you're going to make. So, interestingly, there's different aspects to it, and one of the things that she focuses on is guarantees. When Sotheby's and Christie's have their investments, for instance, they don't want to keep it on their balance sheet, so she guarantees certain prices up to a price, and the market, people actually see it as a store of value, right? And so it's actually more liquid because it's people who are in the art world understand it, right? And wealthier people understand it, and they want to store the value, right? So it's been interesting. So I think art right now is a very interesting place to play. So that's one asset class. I don't really understand biotech. I do know other family offices that are very heavy in it, and I think for me, I just played it through an ETF, but probably if you pick, but the interesting thing though is a lot of the top funds though are getting crushed in biotech right now. So, but there could be opportunities. I mean, it's hard to value that because that's really what the FDA or it's kind of different. But so I think hard assets also, anything that has hard assets where you can measure, it's back to the basics, balance sheet. What does the balance sheet look like, right? Because I think we all forgot that before, right? When growth was in, it was, what does the revenue look like? I mean, your net income look like from 100 years from now, like Snowflake and all that, right? So just stay away from that. Look for fundamentally good companies that have strong balance sheets, and then measure it from there.
Yes. In this regard, I think this is a cool question. Perception about Florida. Florida is like Australia in that you have some coastal areas plus Orlando, and then the rest of it's all country. And I say that because it's very important that Florida has a lot of land, and this moment it's a very, say, pro-business regulatory environment. So a lot of opportunities when you get in regard to like changes. Right now in California, with these drought issues, a conversation we're having in Florida right now is actually having food manufacturers actually move to Florida because that's more stable. Another part is that we have the citrus industry is kind of on its way out, and so we have all of this agricultural land that can be for other uses. Another part is that Florida is very bullish right now on broadband, and so there's a lot of opportunities in terms of making new data centers, crypto mining, anything related to that aspect. Manufacturing itself, again, the state wants to be on the plus side of supply chain, so a lot of emphasis on job creation in biotech, medical devices, aerospace, and then multifamily to house all these workers, all these people coming down. And so, and then lastly, toll roads. There's a Spanish company that's made quite a bit of money on the fact of simply financing the toll roads for the Orlando area. And so I would say if you were to look at Florida as third most populous state, view it as a baby, like a little country that is at least right now, the way that its government is for the next 10, but really I say 15, 20 years, it's a place where you can really focus on looking at what's needed to make it an export type location, as well as meet its local needs. And lastly, because we're dealing with the transportation as a big issue, things like truck parking and accommodation to be able to really facilitate inland ports, things like that. I mean, we're even willing from the state side, even willing the state even create the easements and everything for it. So there's just, if you can view it kind of like an advanced developing country in the sense that, yes, we're part of the United States, but there's a desire now to come out of our two industries, which are agriculture and tourism, but actually move into a lot more productive industry right now.
I should add too, though, just if you think about region, a lot of times when people talk about Asia, you hear China and India, but you know, I think there's other interesting places. I think if you think about Vietnam, Indonesia, with Singapore being in the middle, there's really a ton of opportunities there too, because I think that those countries kind of get it. They're fortunate for a few reasons. Technology is allowing them to grow a lot quicker, number one. They're very fiscally disciplined. In Indonesia's constitution, you can't have, debt can't even be more than 25% of their GDP. So very disciplined. And then three, just it's a young population, and people are and it's growing, and they really have a focus on the math and sciences. And then fourth, what China has done is it's providing liquidity. I can't stress enough what Alibaba and Tencent, how active they are in those regions, and the liquidity that they're providing to those places. So region-wise, I think that's, you know, people forget about that, right? So they think about China, but the Chinese multinational companies are very, very, very active there, along with Japan and North Korea providing liquidity. So the issue that the region had 10 years ago is that there was no liquidity, but because that region understands what's going on there, they're providing liquidity because they're quite frankly really strong companies, not just Alibaba and Tencent, but in Japan and in Korea. You know, you think about some of the national powerhouses like Samsung, et cetera. So I think that in terms of, you know, when we think about Florida, region-wise too, those are interesting places.
There's one important point about Indonesia, I really love Indonesia, is that working with corporate Japan, there was an issue where Japanese companies would never open in areas that didn't have the capacity to consume what they produce, so that those products produced wouldn't compete with the domestic labor. In the same way as you find a lot of foreign car makers now, let's say in the U.S. South. And I find that if we look at areas where if that's part of the model, is that if that local area, whatever country region can absorb what you're creating there, that's a lot safer investment. And I think that's especially like right now, Indonesia is in that space now where it's middle class has moved to the point where now it can consume what's being produced there as opposed to it only being a place to produce things for other people.
Just curious, if you don't mind, if you have an opinion one way or the other on Latin America, given its proximity to us as a region.
You know, I think Latin America, it's going through, so I spent a lot of time in Chile, about around 2012, and it was a very alarming bellwether when that government lost. And I was talking to a friend from Chile right now, and it seems like they're going through a leftist phase. I lived in Brazil also when Lula was there for a little bit, and the choices are terrible between someone that I think is worse than Trump. I don't know how people feel about that, but you know, between him and Lula, the options don't. It's either super leftist or super right, right? And then Venezuela is just a tragedy. That was one of the wealthiest countries in the world, right? And it just, and the reason why I think what separates Southeast Asia from Latin America is that and corruption, right? Like for some reason, you know, even and I do feel that the Mexican president is trying to get rid of corruption, which is why he gets a lot of heat a little bit. So I do think that Mexico is trying to change, and if I was going to be optimistic of one country, it'd be there because the Constitution does work, and they're trying to get rid of the corruption. But I think why I'm a little bit more bullish on Southeast Asia is because there is a singular focus in Asia to work as a community. They understand education. The presidents tend to, I'm not saying there's no corruption, but there is this will to try to bring all those countries up that South America just doesn't seem to be able to capture. And like I said, with Chile, you know, Chile was a small country, but it's kind of crazy, right? Because they were a model country. So, and then Argentina, I mean, who knows? Argentina is constantly, you know, anyone that you know, invests in Argentini's sovereign debt probably shouldn't have a job, right? Like the history is there all the time.
It didn't come up. I'm curious why, other than just don't have an opinion one way or the other. It may not matter given the rest of the regions.
Well, I mean, so that's interesting because the city of Medellin has actually.
About Medellin because of the digital nomad
Yeah.
developer communities and things that are emerging crypto-wise.
Yeah, I mean, the city of Medellin seems to get it. They've had a very pro-business economy, but it hasn't spread throughout the country. The politics, it's hard. The scaling issue has been difficult, and if Brazil was probably, I think, the best bet because it's big, you can scale, but you know, it's just the corruption. It's just they haven't gotten it together. So like when you're thinking about businesses and investing, you always think about scaling, right? And so I mean, that's what, even though Chile did really well, it was, you know, only a population of 19 million. And then you think about, I mean, Brazil, I think Brazil is 230 million. Mexico is 125. So if you could figure out, you know, what type of technology can fit there and scale, but they just haven't figured it out.
I'll just say, if we were to think about our role as business in regard to these governments, it is to provide them with what they need to not have the conditions deteriorate to the time where populism ends up becoming necessary. Like then with Japan, the relationship between banking, industry, and government was one that there was a social goal of creating a large middle class. And I think that if there's going to be a role, if we're going to interject ourselves in foreign affairs, is to help those governments be able to provide that environment so that populist leaders don't have to come into play to try to address like very terrible social issues.
All right. I just think we should end there. I just want to thank Jaha and Sasha for providing your views. Thought it was a super interesting last panel. It is a difficult time to have a panel discussion. So thank you very much. Please join me in thanking Jaha. And then just very quickly, I'm not going to do a long summary because it is lunch is sitting over there, but I did want to give a shout out to the SWFI team for pulling the event together, particularly Aiken Gump for giving us this beautiful office space over the last 2 days, and to all the speakers and great audience engagement as well. So please give yourselves a big round of applause.
Thank you, Rachel.
And please, next event, I don't think the exact date has been confirmed yet, but likely April in Austin next year. And for you golf fans, Michael has promised me there will be a Top Golf as networking event as well. So thank you very much. Lunch is over, served over there. Thank you. Oh, and photo.
That's good.
I'm just going to get Johan to take a picture quickly. Yeah, yay, now we can go outside. Does she have to tomorrow? She can fly out tomorrow morning at 9?
Yeah, 7. That's right. I'll be here. 6 hours.
Oh, okay.
Everyone was talking about Asia.
Yeah, I said Business Project Council for and half Filipino, so I go back and forth. That countries, besides what you do about the media, whether it's
Right, those
day
two
or
right there. So you can just
Yeah.
jump right into it. Yeah, can I just go quickly up back?
and then it would be like I think like they've done a lot.
That's so
Jokovic is turning out an age of pushing for change. Philippines also. If you were there before the Turkey, the country's a disaster. Okay, but so if you just look at how they handled COVID and all that stuff. So I think like they're disciplined, and just because they're not pro-US doesn't mean they're not terrorists. No, make sure you and I are don't do but we do a lot of real estate, grow, things that we how about you? Okay. Okay.
Sure.
I'm just going to say like this coming out of here.
Okay.
One of my
Questions about
what is your
what he likes about our bags and why we enjoy it. She could have been a bad person. Honestly,